In this video, I will tell you everything you need to know about the latest results from MSCI. They just reported earnings for the first quarter of 2026. And in this video, I want to do a complete analysis of what they said, a complete analysis of all the numbers. And apparently the markets liked this earnings report. The stock is up 5% during the day of the report. So what will we do in this video? In this video, I want to show you my analysis of the press release of the earnings report. I have many comments, many colors, as you can see here. I will do a step-by-step analysis of the earnings report so you really understand all the moving parts, everything that is happening. Then after, we will go through the slides, the investor presentation, and also I have some analysis, some comments to make so you really understand what is happening. After this, we will go through my own Google Sheet where I did some work about the numbers, the analysis, the margins. I have some comments. There are some adjustments to make to really understand what is happening here, and I will show you everything. And after this, together, we will listen to the earnings call. We will go on Fiscal AI, Investor Relations, transcript, and together we will listen to the earnings call. The call is 1 hour long, so this video will be long because this video will be complete. And after watching this video, you will have all the information, everything you need to know to really understand this earnings report, and you will be able to understand if this is warranted. Now the market is up for MSCI. Wall Street liked this report. Is this normal or not? And I can spoil you the fun right away because I liked this report a lot. Okay, I think it's normal for the stock to be up because the report was pretty good. And there are many signs of reacceleration in the business in this new AI world. MSCI is an asset-light company and they are implementing AI everywhere to grow a lot more with better margins. So we are in a bull thesis here. It seems like they are delivering in a very nice way. And in this video, I will tell you why, okay, how they are doing it. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to help you become a better investor. Okay, so in this video, you will understand how to analyze an earnings report. Just before we start, let me do a quick 2-minute recap of what is MSCI, the different segments, all the moving parts, so you understand the story. MSCI is a big company, market cap of $40 billion, and they have different segments. Half of the business is the index segment. So that's the benchmark, right? If you are a fund manager and you want to benchmark your performance versus the S&P 500, you pay S&P Global. If you want to benchmark yourself versus the MSCI World, you pay MSCI, okay? So this is the big company behind the MSCI World. And this is their cash cow, right? Most profitable segment, a beautiful margin. And over the past couple of quarters, the strategy for MSCI was to use AI to create more custom indexes and grow more in this index segment, okay? So that was for 50% of the business. 25% of the revenue, that's analytics, okay? So software, data, proprietary data, helping fund managers analyze the risk, what if scenarios, all these kind of things. So analytics, high margins, but it's a software company, so maybe AI disruption risk, okay? For the remaining 25% of the revenue, that's half ESG, so software and analytics for ESG. It was growing a lot during 2022, now not growing at all. So the strategy for MSCI is to stop growing because the market is almost very slow and almost stable, but they want to improve profitability. And for the rest, they have a small segment, private assets, that is much less important than the rest, okay? So majority of the business, index, high margin, beautiful, royalty business model, 25% analytics, 25% ESG analytics, and private assets. And what I like about MSCI is the margin profile, gross margins of 80%, operating margins of 50% and improving. If you look at the revenue growth rate over time, look at here. in blue, up and to the right. Net income, up and to the right. Free cash flow here, in blue, up and to the right. The company is using debt to do some good buybacks, and they are doing buybacks the smart way. When the company is cheap, they increase buybacks. So pretty good capital allocation. The CEO is still the founder. Okay, the founder is still the CEO, Henry Fernandez. He owns 3% of the company. So you have skin in the game for a quality business that is growing double digits, very profitably. The debt is reasonable, and you have a return on invested capital here, a ROIC above 20%. So quite efficient, doing buybacks, and that's it. Okay. And full disclosure, I am a shareholder of MSCI. It is 13% of my portfolio. Okay. So I have a lot of conviction in this company, and I bought in 2025, okay, when the valuation became reasonable. Now that you know big picture what is MSCI, let's start. I talked about the different segments, you will understand better. Let me put it in big, let me put my face in small, and this is it. For the first quarter of 2026, can I put smaller anyway? Let's see what they have to say. So first page of the report, the big numbers. The operating revenue is up 14%. So as I told you, business as usual. And the organic operating revenue growth rate of 13%. I have different colors for you. Green means good. Yellow means okay. Blue means to be adjusted. And you will see, here you see a diluted EPS on earnings per share of 50%. You will have an adjustment. And I have what is red, that's bad. Okay. You will see in this report you have more green than red, but you will understand my point. Let me stop right there. Let me take my time, because the revenue is up 14%. And this is a clear reacceleration compared to the past. You can go to Fiscal AI, check the revenue growth rate, check on a quarterly basis what is happening, and let me show you the revenue reacceleration. Boom. For the past 10 years, in blue here, that's the revenue growth rate. And you can see here that's at 14. The revenue is growing at 14%. Last quarter, we didn't have this. It was growing 10% per year. Before this, 9%. Before this, 9%. Before this, 9%. Before this, 7%. So clear reacceleration. First question you need to ask is why? My guess is AI and also huge improvement of the index segment. But you clearly see a reacceleration of revenue. It seems like this business is not dead because of AI, but actually improving in this new world. Okay? So very good. This is why I put it in green. Recurring subscription revenue up 8%, 9%. Pretty good. Nothing outstanding here. And this is what is important. Asset-based fees up 26%. As I told you at the beginning of the video, 50% of the revenue comes from the index segment, the benchmarking segment. So the more capital that is indexed to the MSCI world, the benchmark, the more money flows into MSCI, because MSCI gets a royalty, a small cut, a small fee out of all the capital that is being benchmarked towards MSCI indexes. So if you have more capital, more money that is being benchmarked to MSCI, well, you get more royalties. So it's almost 100% operating margins over there. Beautiful margins. And the AUM grew 26%. The asset-based fees were up 26%. So 26% more capital being benchmarked to MSCI. This is huge. And I will show you later the big picture of this. Don't worry. I will show you the charts. I will show you the trends. Don't worry about this. I will show you everything in this video. Take your time. This is huge. And in the first quarter of 2026, markets went down. So the asset-based fees are not up 26% because markets are at all-time highs and we are in a raging bull market. No, markets were down or flat. It's just more inflows of capital. But if you are a proper shareholder, I mean, I'm a proper shareholder, I do the due diligence with all the competitors. And actually, I was not surprised to see this fee up 26%. Why? Because I said, as expected, because you could cross-read the AUM, assets under management growth, with BlackRock's 20% AUM growth. Last week, BlackRock reported earnings and they said the AUM grew 20%. So an asset management company is growing AUM 20% per year. And I checked the report. You had the markets that were down or stable. It's just more capital. So all the asset management companies will have the same trend. I was not surprised. BlackRock is growing AUM 20%. MSCI is growing AUM similarly, 20-25%. So this is why the growth rate is so big for revenue. Big inflows of capital. And in the slides after this, I will show you how big the inflows are. And I can already spoil you the fun a little bit, because if you go to Fiscal AI, you will go to segments and KPIs. You will go scroll down here to cash inflows on a quarterly basis for the past few years. I can show you actually the past decade. This is the biggest cash inflow we've had ever for MSCI. Despite the volatility in the market, despite the geopolitical tensions, it is the biggest cash inflow ever for MSCI. Which begs the question, what will happen when markets recover? What if now we enter a bull market and stocks go up meaningfully again? This new cash flow will be put to work and the fees coming from AUM will grow immensely. My point is, if markets are stable and you grow 26%, what will be your growth rate when markets go up 10%, 15%, 20%? Okay? It's very bullish. It's very bullish. Let me continue. Operating margins are up 53%. Adjusted EBITDA margins, okay, we'll talk about margins later. Diluted EPS, so earnings per share, up 50%. Wall Street and beginners will get confused here because the real earnings per share is not up 50%. And they say it rightly, adjusted earnings per share up 14%. I like it way better. Actually, during this earnings report, there was a tax change. And during this quarter, they didn't pay any taxes. And if you don't pay any taxes, of course, earnings will be huge. So you have to adjust for this one-time tax change. And if you really adjust the profit margins and the tax rate, the real earnings per share are up double digits, like 14% per year. Okay? Which is quite reasonable. So revenue up 14%, earnings per share up 14%. Organic recurring subscription revenue growth of 8%. That's okay. And retention rate of 95%. This is okay. In the first quarter, we did some buybacks of $450 million. And we had $150 million in dividends. Fair enough. As you can see here, from the first page again, the operating margins are going up on a year-on-year basis compared to last year. Operating margins went from 50% to 53%. And later in this video, in my own Google Sheet, I will explain why. Okay, let's see what the CEO says. In the first quarter, MSCI delivered a strong financial and operating metrics, including a record asset-based fee run rate and our best Q1 of recurring net new subscription sales since 2022. Best quarter when it comes to reacceleration in Q1. Among product lines and client segments, we posted record levels of Q1 recurring sales in both index, the big part, and analytics, 25% of the revenue, along with our best ever Q1 recurring net new sales with hedge funds and with banks and broker dealers. How bullish do you want to be? The CEO is clearly pumping the results, said Henry Fernandez, the chairman, CEO, and founder of MSCI. Clearly, when you look at the first sentences from the CEOs in earnings release, you can get in their head to say what is their priority. Now their priority is to be very proud of their results. They are, pumping the results, pumping the stock price, but they are very proud to say this is our best quarter ever when it comes to Q1, record inflows, record earnings per share, all these kind of things. These results affirmed MSCI's foundational mission critical role, okay, and we are building our relentless AI-fueled product innovation. Again, what the management says publicly, especially in the first page of the press release, the earnings report, is really important. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So they talked about a record Q1 report, and they also talked about AI. Okay, it will be pretty interesting to see how they are implementing AI. And now let's go a little bit deeper, line by line, so you understand everything. Let me start by, where can I put my face? Let's say here. The operating revenues are up 14%. Organic operating revenue growth was 13%. Pretty good, right? I mean, I bought MSCI because it was growing revenue double digits and you had margin improvement over time. They are delivering. The run rate is okay. We don't care about this one. Expenses. The operating expenses are up 7%. It is a beautiful operating leverage. The revenue is up 14%, but the costs are up 7%. You have a delta of 7%, and this is why operating margins go up. Total operating expenses, excluding the impact of foreign currency exchange rate fluctuations and adjusted EBITDA expenses, ex FX, increased 4% and 5%. So the business is growing revenue 14% and the costs are not following. This is beautiful, which means the operating income is up 21%. The core operations of MSCI are growing 21% per year. This is beautiful. And why are expenses not following? First, because of the way the business is designed, minimal cost, very asset light. And secondly, because they don't hire anymore. If you look at this line, the headcount, you have 2% more employees. They don't need to hire meaningfully. They are just going to implement AI everywhere, and they have slowed down the hiring process in a meaningful way. Don't worry, I will show you the past numbers we've had for the past quarters, and it will show you the deceleration. In the past, the headcount was growing more, like 4 or 5% every year that were hiring. Now they're almost not hiring. 2% more employees. Okay, what do we have next? Other expense that was up 50%, primarily driven by higher interest expense as the result of higher debt levels. The company recently took on more debt, so you have to pay a price, the interest. And why do I say this? We will talk about this later in the Google Sheet. Why is this in black? No, let me put it in red. We'll talk about this later in the Google Sheet. They are doing levered buybacks. Yeah, they are using more debt to do more buybacks. And then here is the interesting part to be adjusted. Income taxes. The effective tax rate decreased to -4%. So they did not pay taxes. They had a tax benefit in the first quarter compared to 12% last year. As previously disclosed, they discussed this in the last quarter, so Q4 2025. The company commenced a multi-phase internal legal entity restructuring. In connection with the completion of the subsequent phase of this restructuring in the first quarter of 2026, the company had a $88 million tax benefit. So this is why taxes are negative. Don't worry, I will explain later. We'll talk about this later in the Google Sheet exactly. They announced this in the last quarter. And obviously, if you don't pay taxes, it boosts the net income artificially. They are cheating a little bit. This is why the earnings per share figure here is in blue. You have to adjust it. Don't base your valuation model based on this. Okay, that's it for this page. Now I want to talk about the different segments. Okay, index, analytics, ESG, and private assets, because the expectations are not the same. For the first segment, the index segment, the message was really clear. In 2025, they explained exactly what was their plan for each segment. For the index segment, we expected massive growth and maybe lower margins because they invest in marketing. They recently hired a lady that is a superstar in the industry to boost index. So maybe they will grow the marketing and their sales department to, have deals with more customers and improve the revenue meaningfully. Well, the revenue is improving meaningfully. If you look at the index segment, the recurring subscriptions are up 9%. The asset-based fees are up 26%. You have a massive inflow of capital, as I told you recently, going into ETFs. 1 week ago, BlackRock grew AUM by 20%, so it was to be expected. And then I say, look at page 17. This is why reading earnings reports and understanding this is really important. Who reads the page 17? Here we are. Page 17, you have a table, an appendix, the AUM in ETFs linked to MSCI equity indexes. It will get a little bit complex, so I will go slowly. Stay with me, okay? This is a table that shows you, 1, the inflows, outflows of capital, and 2, the market appreciation. So, at the beginning, we start with the yellow, the beginning AUM, assets under management, that are following MSCI. At the beginning of each period here, okay, you can see quarter per quarter, it was a 2.3, okay, 2,300. In red, that's the market appreciation, if the markets went up, or in brackets, the depreciation. As you can see, last year, markets went up, and then this other quarter, markets went up, and now that's in red because you have brackets, markets went down. This is what I said before. You had a lot of inflows of capital, but markets went down. And this is the cash inflow in green. 40, 50, 40, 60, 100. Biggest cash inflow we've had in a while. Ever, actually. Markets went down, but cash inflows were up, so the AUM was up. Markets going down, but massive cash inflows, this is the largest ever, that shows the resiliency of the business model. Now, what if markets go up in 2026? What if we just saw the bottom for markets in 2026? Nobody knows where markets will be in the future, if they will decline or if they will grow by how much, decline by how much. But if markets grow meaningfully in 2026, MSCI will print cash. The fact that despite the geopolitical events, all the uncertainty, the tariff issue, etc., we have the largest inflow of capital ever by a huge margin is extremely bullish for MSCI in the future. Meaning the growth can reaccelerate again. Okay, and also I have put this in red because that's bad. The period and basis point fee. What is the royalty cut you get? What is the royalty fee you get out of all the capital that is following you MSCI? In the past it was 2.4 and then it was reduced to 2.3 because they renegotiated the 10-year contract they had with BlackRock last quarter, but at a lower fee. So it was to be expected. They announced it a couple of months ago. Okay, a big risk MSCI has is customer concentration. 10% of the revenue for MSCI are linked to BlackRock. If they lose this big customer, they lose 10% of the revenue. And they don't want to lose it. They already lost Vanguard in 2013, and the stock crashed a lot. The profitability was dragged down a little bit. They don't want to lose a big customer again. So very recently, like 3 months ago, they renegotiated a contract with BlackRock to extend the relationship with BlackRock for 10 years until 2035. So let's say 10 years. And to renegotiate this, they lowered their fees a little bit. That's fine. This lowering of the fees is not something that is recent. You can check on Fiscal AI, another KPI here, the period and basis point fee over the past couple of quarters. In the past, the royalty fee they got was 2.8, and then 2.7, 2.6, 2.5, 2.4, 2.3. And if you look at the long-term trend on an annual basis, since 2014, in the past it was a 3.4, 3.2, 3. It is decreasing, right? It's bad. This is why I put it in red, but we cannot do anything about it, okay? So you have more capital, more inflows, more AUM, but every time the cut is getting smaller and smaller and smaller. So now you have a beautiful AUM. This is the amount of money, amount of capital following MSCI, okay? So I put it in red because that's bad, but they have no choice. They had to renegotiate a new contract and extend the relationship with BlackRock. By the way, you see me on Fiscal AI, on the KPIs here. It's a beautiful tool to check everything in real time. And after we will use Fiscal AI to have the transcript, you have the report, you have the slides, you have an AI summary here. It's lovely. You can use Fiscal AI completely for free for 2 weeks. I have a code in my description to create an account completely for free. You can try it out for 2 weeks. And after 2 weeks, if you like it, it will get 15% cheaper if you use my link. So in case you don't use Fiscal AI, please do so. I mean, it's a mega platform. You will see me navigate, use everything, all the metrics on Fiscal AI. You can create your own custom metrics. I will show you this later to have the profitability of each segment. It's a lovely tool, and I highly recommend you use it. Okay, I'm using this on a daily basis. You can go on my description, click on the link, try it out for 2 weeks, and then it will get cheaper to use it if you go through my link. Okay, so it was for the page 17. I've seen no one talk about this on YouTube or on Twitter. I don't know why. People don't know how to read the page 17, but this is why we are here. Okay, so am I done? Done. So that was for the index segment. For the asset-based fees, saying markets go down, but fees go up because of capital inflows. So if you have operating revenues for the index segment that grows at 17%, this is huge, by the way, you have better margins at the same time, higher margins. The margins for the index segment went from 73% to 75%. They are talking about adjusted EBITDA margin. I don't like this measure of profitability. I prefer net income margin or free cash flow margin, but it is the best we have, unfortunately. Okay, so I'm doing with the best tools I have. And on Fiscal AI, I created a custom metric to check the adjusted EBITDA margins over time. As you can see here, in the past, 10 years ago, it was at 70%, and then it grew to 72%, 76%, and it is growing, okay, nicely. You can look at the year-on-year change. As you can see here, last year it was 73%, now it's 75%. And on the last 12 months basis, margins are at all-time highs. So the biggest segment is having margins at an all-time high. Wonderful, beautiful margins, very, very high. And at the same time, this segment is growing a lot. I can show you the growth rate. I click toggle on percentage change, index operating revenue. You have a clear reacceleration of this segment. Look at this. This is the revenue growth rate for this segment. It was at 10%, it was stuck for 2 years at 10%, 10%, 10%, and now 14%, 17%. If markets go up, it will be more than this, like above 20%. Okay. What do they say? The increase in asset-based fees run rate was driven by higher AUM in both ETFs linked to MSCI equity indexes and non-ETF index funds linked to MSCI indexes. Fair enough. Fair enough. That's it for the index segment. Now the analytics segment. As I told you, it's 25% of the revenue. High margins, but not extraordinary. We expected low growth. They said it before. But higher margins. They want to squeeze the juice out of this segment. And what do we have? Recurring subscriptions up 8%. Non-recurring, that's non-meaningful at all. That's meaningless. So the total revenue is up 10%. Pretty good. We expected low growth and we have double digits. Pretty good. If you look at analytics, I can show you the past so you can understand the trends. Let me put the percentage change for analytics. This is it. You have the same thing that I showed you before. For 1 year, the revenue growth rate for analytics was stuck at 5%, 5%, 7%, 6%, 5%, and now we grow 10%. Why? How can you double your revenue growth rate? Pretty strange, okay? So that's good, but okay. Let's see if it continues in the future. I don't think this metric will continue in the future. I think the analytics segment will go down to single digits. I am not very bullish to the analytics segment in the future. I'm very bullish for the index segment for all the reasons I mentioned before, but I'm not bullish for analytics. I just don't like it. I think the revenue growth rate will go down now. I mean, I'm surprised. How can you grow 10%? And at the same time, the expenses are up 11%. Expenses are up more than the revenue, so you have lower margins. Margins went from 44% to 43%. We expected higher margins. They did not deliver. And it is not the first time it happens. For the past few quarters, they've been talking about higher margins, higher margins, higher margins. It is not happening. So, no, I don't like it. This is your profitability segment. Adjusted EBITDA margins. They want to have higher margins. And for the past year, margins have not gone up. Margins have gone slightly down. So please increase. Please make margins go up again. Maybe they will talk about this during the earnings call, but I want to know what is happening here. Why are you doing the reverse of what you said? You said low growth, high margins, and we have the reverse. So really strange. Analytics run rate was 8%, which is okay, basic. What about the other segment? The ESG segment that they called sustainability and climate segment. We expected the same thing as analytics. Low growth, but higher margins. Please squeeze the juice and make shareholders proud. Well, let's see. Recurring subscriptions up 10%. Then this is insignificant. So in yellow, total operating revenues are up 8%. Lovely. And the expenses are down 3%. Costs are not up. Costs are down. So obviously, if you improve your revenue and at the same time you reduce your cost, margins will get lifted a lot. The adjusted EBITDA margins went from 28% to 35%. So they delivered beautifully for the ESG segment. So organic operating revenue for growth was 3%. Almost no growth. If the organic revenue is up 3%, but the total revenue is up 8%, you have a delta here. From 3 to 8, you have 5% of delta. The difference is acquisitions, organic growth rate, and M&A growth rate. Almost no growth. They need small acquisitions to grow again in ESG. And in the past, this segment was growing 20% annually. So it seems like the ESG segment is stable and I see no catalyst in the future. Similarly, I can show you the growth rate of the ESG segment so you understand my point. I can show you that in the past, it was a segment that was growing a lot. Like a lot. Look at this on a quarterly basis. In the past, in 2021, it was a segment, the ESG segment was growing at 50% per year because it was the hype, trend, ESG, political movement, but all the companies in the world embraced ESG in a zero interest rate environment. At the time, I remember 2021, 2022, I was working in a ESG fund in Paris. So I know exactly what happened in this industry. Like I know exactly because I was part of the equation. I saw with my own eyes how important ESG was in the past. And then like any fad, any trend, it faded away. from 50% growth rate to 30% growth rate to 20% growth rate, and now single digits. They are not growing anymore because the hype is no longer there. Everyone that wanted to embrace ESG already embraced ESG. They already have the tools. You will struggle to have new customers. Anyone who wanted to be involved in ESG already has the tools. So very difficult to get new customers. And now the growth rate is 8% for revenue, but they are cheating a little bit because of acquisitions. They said the organic growth rate was 3%. So no growth. In the future, you can expect a decline actually. I would not be surprised if we go to 0, -1, -2%. But about profitability, this is really interesting. Again, I created my custom metric. Fiscal AI is the only website where you can create your own custom metrics. And this is why I highly recommend Fiscal AI. You can check the sustainability adjusted EBITDA. In the past, this segment had an adjusted EBITDA margin of 15%. And as the growth declined, the profitability increased. It went from 15% to 25% to now 35%. Now it's at 35% adjusted EBITDA margins. Last year we were at 28%. So this is still growing in full force. They are beautifully delivering. Margins are at all-time highs on a last 12 months basis. So if I sum up, index, beautiful, better than expected. Analytics, they did the reverse of what was expected. For ESG, they beautifully executed what they said. What about the other insignificant segment called private assets? We don't expect anything from private assets. Let's not kid ourselves, we don't care about this. But they said low growth and higher margins. This segment is less important. This is a new segment and this is a small segment. And this is a little bit more speculative. The revenue was up 8%. And the expenses were up 10%, almost 11%. So margins went down. They did not deliver. Margins went from 21% to 18%. So not good. I can show you very quickly, because that's less important, but very quickly the trends so you understand. All other private assets, they are doing acquisitions in this segment. Big acquisitions in 2023. So the growth rate is up, down, up, down. It's a mess to analyze. It's a new segment, so they're trying new things. Anyway, if you look at the recent quarters, growth of revenue is 7%, 5%, 10%, 10%, 8%, 8%. So nothing shocking, nothing reaccelerating. And what about the margins? All over. We don't care. Up, down, no meaningful trend. Last year it was 21, now it's 18, 19. Okay, I don't expect anything from this segment. I don't expect anything. I don't care about this segment. I think it's not important. They are trying new things and it will be a segment for the future, but not now. It will not move the needle for MSCI, so I don't want to spend a lot of time on it, okay? Just so you know, it's a new segment. Okay. So overall, if you look at segment per segment, pretty good, right? What is important for them was in a good direction, okay? On overall, better margins and a good growth rate. Now about the balance sheet. They have a cash of almost $400 million in their cash. They want to maintain a minimum cash balance of $200 million to $275 million, okay? So they have a little bit of a cash burn here. Total principal amount of debt was $6 billion. The total debt to adjusted EBITDA ratio was 3.2. I think this is reasonable. They can use more debt in 2026 to do more buybacks, in my opinion. Because their target for debt is to have this ratio between 3 and 3.5. They recently took on more debt, and this ratio went from, I think it was 2.9 to now 3.2. So they are still in the range. But as the fundamentals get better, and free cash flow will get better, adjusted EBITDA will improve over time, this ratio will go down, okay? So I think maybe at the end of 2026, maybe they will announce a new debt program for a new buyback program. If you look at the capex now, capex was $30 million. I'm putting it in green because that's a business that is asset light, not capital intensive at all, with minimal capex. And I love it. Low capex, even if you look at the capex plus the software capex, what they call the capex for intangibles, that's 9% of operating cash flow, very asset light. And it is where you will be very happy, my viewers, because I'm the only YouTuber talking about this line. Okay, yeah, let's thank you for clicking on my video. If you go to the cash flow statement, you can check the line called capital expenditures, that's the capex. Most people will say this is their capex. And effectively, this is not true. This is not enough because they have another line, the software capex, where they say purchases of intangible assets. This is a capex for software. You have two lines, and some specific websites only look at the blue line, the capex, and that's it. This is a mistake. You really have to take into account the orange line that was almost zero. And as the world is moving into more digital, more AI, you have software capex in orange that is up and up and up and up and up. Okay? So people only looking at the blue will say, this is not growing, capex is insignificant. You have to do the sum of these two. And you don't have to do it because I did it for you. If I do the sum of these two lines, blue and orange, I created a custom metric. And this is this one, capex plus intangibles as a percentage to operating cash flow. Boom, this is what you have. 9%. Last year, it was at 11% and now 9%. So, first point, as you can see here, is the total capex plus intangibles, the total capex represents less than 10% of the operating cash flow. OCF means operating cash flow, right? So minimal capex, very asset light, and COVID did not impact the capital lightness of the business. AI did not improve the capital intensiveness. They are still very asset light. And if you look at a year-on-year basis, the company is becoming even more asset light. Last year, it was 11% of the operating cash flows, now 9%. Okay, let's see in the future. We are talking about decimals here, so I don't want to spend a lot of time here. The point being, they are still very asset light. And what do they do with the cash? If they don't do any capex, if they don't have a lot of capex, what do? Well, they are doing massive buybacks. They did repurchase 5.7, so let's say 6% of shares year on year. They did a buyback of $414 million in the first quarter of 2026. They continued their buyback policy. So business as usual. They said it in the past, they will continue, it makes sense. No surprise at all. Actually, they could have done more buybacks, $100 million more, but that's okay. As you can see here, they in yellow here, they have a cash balance of $380 million. And the minimum cash they want in their balance sheet is $275. So, I mean, you could have done $100 million more to be at your minimum level of cash, but that's okay, guys. Okay, the trend is the same. As you can see here, the buyback program is still strong. They are still doing a lot of buybacks. I can show you the operating cash flows over time, and I can show you the buyback program over time. Okay, boom, boom. In blue, that's your operating cash flows. Up and to the right, resilient, like clockwork, it's beautiful. And in orange, that's the amount of dollars of buybacks. Okay, you can see on a quarterly basis what they have. Beautiful. 2 quarters ago, they did $1 billion. 1 quarter ago, so last quarter, $1 billion. And now $400 million. Still strong. Still a strong buyback program. So they did repurchase 6% of their shares. Also, they paid a small dividend of $150 million. That's it. Dividend has increased. What's next? Next, they talk about their guidance. There was no meaningful change in the guidance. They only increased this line by $5 million. Depreciation and amortization expense from, that's the prior guidance, from 185 to 195 to 190 to 200. So by $5 million, that's peanuts. We have a small $5 million increase in D&A cost guidance, maybe because of the acquisitions. They did, I think, at least 2 acquisitions during this quarter. And I don't believe this is meaningful at all. This is irrelevant to my analysis. So let's assume the guidance has not moved. Okay, second point that they mentioned in their guidance is this point. This effective tax rate has not changed, 18% to 20%. This is strange, right? I told you at the beginning of the video that there was a restructuring process, so for this quarter, they did not pay taxes. So why don't you adjust your guidance for the tax rate if you will cheat on this? Well, you can check the footnotes. The footnotes here. For the effective tax rate, it includes the impact of a multi-phase internal legal entity restructuring. In connection with the completion of the subsequent, we recognize a tax benefit of $88 million. And we exclude this from our guidance. So, I said, I think the real tax rate will be lower than their guidance. I estimate the 2026 taxes to be $330 million. I've done my calculation, so you don't have to do it. So a tax benefit of $88 million is significant. Okay? So that's almost 1/3 of the taxes that they will not pay. So the real tax rate could be 14% instead of 18 to 20%. My point being, maybe in reality, the profits they will have for 2026 will be higher than their guidance. Don't be confused in the future if you see a mismatch, because now you know. You know what is happening with the tax rate. Let me scroll down. I hope you like this format, by the way. I want to take my time. I long to make these long videos for you guys. Don't hesitate to leave a like, leave a comment, subscribe, become a member to this channel to have information, new videos, and exclusive live sessions. Let me scroll down. I have some other things to say. Okay, this is for the income statement. I will use my Google Sheet for this. What about the balance sheet? The balance sheet, the only notable things I wrote was the long-term debt slightly improved. This is not important. The long-term debt went from 6.2 billion to 6.4 billion. That's it. Scroll down. Debt balance sheet is not important for this company. And for the cash flows, what do you have? For the cash flows, I wrote 3 things. 1, business acquisitions. So they paid $40 million of cash to make small acquisitions. Is this big? Is this not big? You will see. Net income provided by net cash provided by operating activities. So operating cash flows in the quarter were 300. The acquisitions were 40. So acquisition is small. It's a small acquisition for Compass for $40 million. It will be added to the index and it will boost the index revenue in the future. I think there is, includes cash paid for the acquisition of Compass, Financial Technologies, and Vantager. I have the link here, but in the slides, they will talk about the acquisition. Okay. And also, something they did not mention in the earnings report is another acquisition they made. They acquired PM Insights, but it seems insignificant. Okay. So, 2 acquisitions for the index segment. So the biggest segment, the most profitable segment, growing 17%. Another bullish things. If you make acquisitions, you will absorb their revenues and it will boost the revenue a little bit. So it will push the revenue growth even more. They are doing these acquisitions to widen their moat, to improve their moat. Okay. So this is for the explanation for the acquisitions. And the 2 other things, you have payment of borrowings, let's say $175 million, and proceeds from borrowings, so the kind of new debt you have, $375 million. You have a delta of $200 million of more debt, which makes sense, and that corresponds to $200 million we have in the balance sheet. So everything works fine. This is the kind of work you have to do when you look at an earnings report. If everything corresponds, you know why, you know what moves what, because of what, everything corresponds, everything makes sense. Now, everything makes sense. Let me scroll down. No, we already talked about this one. No, the page 17, table 7, you know why the AUM grew so much. And am I done? I just have this page, the adjustments. It's a little bit technical. I think I will keep it for later. Yes, I think I will keep it for later. It's the explanation of the tax rate. Yes. Okay, let me put maybe a reminder to not forget it, and it should be fine. Now I want to talk about the slides. It will be faster because we already talked about the big numbers, but there are new information on the slides. Let me put a reminder, I don't know, in 20 minutes. Adjustments in 20 minutes. Fair enough. Okay, perfect. So these are the slides, earnings presentation for the first quarter. First of all, they start the slide deck by a new slide. They want to show off. Similarly to the first paragraphs we had at the beginning of the earnings report, this is our biggest Q1 report. To have the largest inflow. We are improving on AI. This is new. And checking the orders of the pages in investor presentations are extremely important. You want to check the numbers and you want to check the format of the slide deck. You want to check if they add some things or they remove some slides. Now you have a new slide and it is their first slide. They are very proud of their results and for good reasons. So where can I put my face? On small here. Highest first quarter since 2022 for recurring net new subscription. For the index, highest ever first quarter recurring net new subscription sales, record equity ETF AUM, I showed you how, I showed you why, adjusted EPS growing 14%, wonderful strategic acquisitions. They are very proud of their quarter. Second slide, as expected, they talk about the big numbers, revenue growth rate, the margins, what they did with the cash, earnings per share, if you do all the adjustments, that is growing 14%. Let me scroll down. They show you the different segments and the growth rate on an organic basis or acquisition basis. For index, no acquisition. For analytics, no small divestiture. For ESG, you have a gap, as we said before. You have a 5% gap between the organic and the acquisitions. So maybe some small acquisitions there. And private assets, we don't care. We don't care about this one. Okay, let me scroll down. This is not important. Yeah, as I told you here, you have a gap between organic and real growth rate. Let me scroll. This is not important. You can just skip this. This slide is important. The Q1 regional performance. How many customers are you getting? How many new customers are you getting per region? Americas, Europe, and Asia Pacific. These three metrics that I put in green here, Q1 recurring net new subscription sales by region, America, it is growing 40% for new customers, reaccelerating compared to last quarter. Europe plus 40%, huge. Asia Pacific plus 90%, triple positive growth and reaccelerating. This slide is extremely important. At the beginning of the year, MSCI and all the data providers were doubted because of AI, Anthropic, Claude. What if AI can replicate all the analytics companies? So many doubts. What if you can create a cheaper alternative to MSCI? Well, it turns out MSCI is important and they are aggressive. They are taking more customers in this AI world because they are integrating AI everywhere. We don't have this trend all the time, right? Last quarter, we had a triple positive, but now it's even better. Some quarters you have America that is plus, but Europe down, Asia down. Some quarters you have America down, but Europe up and Asia down. Now you have a triple positive growth, and all the three are reaccelerating. This is the best case scenario. And by the way, I'm reading all the bear articles on this one. All the articles that are bearish about MSCI. All the guys that are short MSCI. You have a couple of funds, I would not mention names. The hedge funds that are short MSCI, they mention this. And they look at this, and when it's negative, they point it out and say, it's bad, it's bad. And now, for 2 quarters in a row, these 3 metrics are positive. I don't hear them anymore. Funny, right? That's life. That's life. So be careful who you listen to. You want to check complete information. But yeah, this line is extremely important. And I'm very happy as a shareholder to see strong reacceleration here. Okay, let me continue. This slide is showing you the AUM that follows MSCI up and to the right. And it shows you the cut fee, right? The royalty cut, the royalty fee. As I told you, the basis point is declining because they renegotiated their contract for 10 years with BlackRock. Okay, and I expect this trend to continue to go down, by the way. Okay, let me scroll down. Now, this is important. We said we had the largest cash inflow ever on a quarterly basis, best Q1 ever for MSCI. Why? And in the earnings report, they don't mention this, but in the slides, they mention this. So, what about the inflows? Cash inflow, cash outflow. In the US, you had a tiny $8 million or $8 billion cash inflow, meaningless. The US market is not what is moving the needle. But for developed markets ex-US, for example, Europe, $40 million. And for emerging markets, $50 million. So you have a massive inflow of capital coming from all countries outside the US. And now emerging markets are on the way up for 2026. You have new amount of capital at cheap valuations. It seems like capital is going in these markets. This is why you have the largest inflow of capital. Not because of the US, because of the rest. Okay. At the same time, geographical exposure, no. Market cap, no. Let me scroll down. They talk about their guidance, as I told you before. I think the DNA improvement of $5 million, it's because of the acquisitions. So it's nothing. Please don't spend more than 1 minute thinking about this one. No meaningful change. Quarterly highlights. Boom, another new slide. I don't know where I can put my face here. You have another new slide. They want to show off. They want to show how great they are. They want to show how they will implement AI because they know they are being doubted at the moment. As a shareholder, I know this. In February, the stock dropped meaningfully. In February, look at this. This is in this was they reported the last quarter in January. I made a video about this if you want to check on my channel, by the way, saying I don't like this quarter. And then in February, Anthropic and Claude released a new model that will maybe disrupt data providers, and the stock fell like 20%, 15%. They know people are doubting their business model. And now we're back. They know that people doubt their business model, so they want to show you how they will implement AI. So, how will you implement AI? New solutions launched this quarter span AI-powered analytics, private markets, benchmarking and index services, deepening MSCI's world as a one-stop platform for investment decision support tools and solutions across public and private markets. I mean, that's very salesy, I agree with you. I mean, they say we are about to save the world, but they are delivering. Everything is accelerating, so it is working. You have a new index AI insights with a conversational AI interface with thousands of indexes, 20 years of history, and they are partnering up with ChatGPT and Claude. So they are not about to get disrupted by Claude. They are integrating Claude, integrating ChatGPT to be friends with them, partners with them. And this is where the moat of MSCI lies. Because the moat of MSCI is the proprietary data they have built for decades. So you have proprietary data that is doing partnerships with LLMs. So you can fetch information in this huge database, and you can go faster with ChatGPT and Claude. And I hope they will mention this in the earnings call. I hope for them that they double down on these partnerships. ChatGPT Cloud, you want to say these words as many times as possible. I want them to say this, 2 times, 3 times, 4 times, if possible. People are worried about this AI disruption risk at the moment. All the companies are getting disrupted, and MSCI is in this software basket. So you want to see how you will defend yourself. Next point, AI for private markets. Conversational AI interface, 100% LP source data, again, proprietary data. Cloud and ChatGPT, again, expanding to Microsoft Copilot, again, and additional private datasets. Again, you want partnerships with big LLMs. Next one, we don't care. You have a new slide, another one. They want to show how they will implement AI, and they also explain their new acquisitions. Expanding multi-asset and private market platforms through acquisitions. They again talk about AI-enabled diligence at institutional scale, accelerates MSCI's AI-first private asset strategy. I mean, how many times do you want them to say AI? I think in the call they will talk a lot about AI. And they talk about their 2 small acquisitions. Okay, I put this in yellow because I don't think these acquisitions are really important. So you have an acquisition that is about to improve the landscape of MSCI because they want to include cryptocurrencies to meet growing investor demand for sophisticated, customized, and diversified index strategies. I'm not a fan of this, to be honest. I don't like crypto. I'm not a fan of companies partnering up with crypto, but so be it. Expansion across asset classes and use cases. Anyway, that's a mega platform to diversify if you want a benchmark linked to the MSCI World and Bitcoin. Okay, it's not important. And you have a small, tiny acquisition that we mentioned before that they did not mention in the earnings report, but I showed you how. And I show you PM Insights to expand the proprietary data coverage. So they want to have a better moat with their own proprietary data. So new slides to show off, basically. Additional information. Now there is a slide with the balance sheet. They said that in Q1, they returned $500 million through share buybacks and dividends. So yeah, you have a buyback of $400 million and you have a dividend policy of $150 million. As we've seen before, you have a strong balance sheet that provides optionality. And the next maturity, the next moment you have to pay your debt is 2029. So now they have the time. For 2026, you have 0 debt to repay. 2027, 0 debt. 2028, 0 debt. In 2029, you will have to repay $1 billion of debt. That's fine. So there is no debt problem for them. The total debt to adjusted EBITDA is 3.2, and I think it will decrease over time, so they can take on more debt. They will reschedule their debt. There is no meaningful debt problem for MSCI. They have to repay their debt in 4 years. This is fine. Okay, they talk about the dividend policy that is growing nicely. They have improved their dividend payment over time. So for dividend investors, MSCI is actually a good pick. And they are doing more buybacks over time. Okay. This line is not important. This slide is not important. Nothing is moving here. Now, this is important. For the key operating metrics, something you want to monitor, whether you are a bull or you are a bear, you have to monitor this. For the overall company, what is the subscription run rate growth? As reported in blue and organically in green. No rebound for the moment. This recurring run rate growth is growing at 9%, 8%. I see no rebound for the moment. So the reason MSCI is rebounding when it comes to revenue is not because of huge reacceleration of the subscription run rate. No, it's because of more assets. On a normalized basis, fully subscription, etc., this business is growing 8-9%. Maybe in the future it will increase. It will be extremely important. If this line goes above 10, 11, 12%, it will be extremely bullish, but I don't see it for the moment. It's just stable. It's something to monitor in the future. Very important. Then you have a line with the retention rate. Nothing to see here. Every time it was at 95%. So nothing to see here. The business is as usual. And then if you add more granularity in the process, you can check the run rate growth for the index segment. You have a rebound of the green line on a subscription growth run rate. That is very good. As you can see, you have two lines. The blue line here, that's the importance of market appreciation when markets go up, so you collect more fees because the AUM is higher. Or when markets go down, like in 2022, the AUM goes down, the capital goes down, so you collect less fees, okay? So the blue is more volatile because of markets. And at the same time, you have the capital inflows of outflows. The blue line right now, despite markets being stable, is up 25, 26%, as we've seen before. And then the subscription run rate, that's more the core operations, the more sustainable, recurring basis business model. It was at 11%, and then 13%, and then back to 8%, 9%, and now from 9 to 11%. You have a rebound of the green line. It's very good. It is going in the right direction. It's not immense, but it's pretty good. Pretty good. About analytics, no change at all. You see that you don't have a lot of volatility in this sector. No change at all. I don't expect a rebound here, actually. For the analytics, I expect, 5% in the future. So I think this line will go lower in the future. For ESG, as I told you before, the ESG segment was growing 40, 50% at the time, and then 20%, and now 4%. It's very bad. You have a deceleration of ESG. This is normal. The business is not focused on ESG now, but they are focused on squeezing the juice, margin improvement. And it seems like they gave up on ESG growth. And I said, maybe that's a phase during Trump administration. If in the future, for the next US president, you have an administration that is pro ESG, maybe this trend will go up in the future. But I think as long as nothing changes and the current environment stay the same, political wise or anything in the world, I don't expect a rebound in ESG at all. I expect a decline. I mean, it can go to zero. Okay. They are saying this publicly. They have been saying this for a few quarters now. They gave up on ESG. They want to grow margins, okay? And they are delivering on these promises. And for the last segment, private assets, as always, we don't care. Growing, it's speculative, okay? They are doing acquisitions here. Every time you have a big jump, it's because of acquisitions. In 2021, and then a rebound, and then zero. In 2023, they bought another company and then come back normal. So I don't expect anything. This is not important. You have a new slide. For the first time in a while, they are adding a new slide saying we are going to participate in upcoming conferences. Why are you adding this new slide? I'd say they will probably share additional information about AI during these conferences. So yeah, it seems like they want to improve their marketing department. They want to show the world how they are going to shape the business. What's next? Nothing. Am I done with the slides? I'm done with the slides. So new information that we did not have in the earnings report. Now, we already talked about a lot of things. I want to show you my own Google Sheet with my own adjustments. And I want to show you the impacts of taxes, the margins, the different costs, so you know everything. I told you this is the only video you need to understand everything that is happening with MSCI, everything that is moving, okay? And I'm not done. You will have additional information with the call after this, okay? So, I made my own Google Sheet. Maybe let me zoom in so you see better. Zoom in. Put face in small, and that's it. So, March 2025, March 2026. On a year-on-year basis, what is moving? The operating revenue is up 14%. The cost of revenue is up 3%, 4%. That shows you how asset-light the business is. So, of course, if your costs are not following, the gross margins went from 81% to 83%. Margins are going up. What about the other cost, the operating expenses? For the selling and marketing part, it is up 9%. That is quite surprising. I'm surprised this line is not going up more because they want to increase their marketing budget for index, right? I told you they just hired a superstar, a lady that is about to boost the index segment. I mean, this line can go above 10%. Please spend more in marketing and sales, incentives, SBC to your salesman, to your salespeople. So this line could go higher for selling and marketing. Anyway, you have 9%. That is still lower than the revenue of 14%. So expenses, the growth for expenses is lower than the growth for revenue. About R&D, research and development, up 4%, almost no cost. You are implementing AI at minimal cost. Now, general and administrative, that's the salaries I would say. It is less important, but up 20%. The meaningful improvement out of all the operating expenses. And I said you had 2.2% more employees. Is this big? It is not big. How important is it? Okay. This quarter, they hired 2% more people. I mean, on a year-on-year basis. Last quarter, the headcount was growing 2.2%. The quarter before, so Q3 2023, it was also 2.2. Then second quarter 2.5, and then before it was 5.8, 5.6, 5.8. So in 2024, they hired 6% more people, and now they are hiring 2% more people. They are slowing down on the hiring process, and we knew it. We knew about this trend from the conferences in 2025. The same conferences they mentioned at the end of the report. They say, we are going to share more information. Please participate in our conferences. This was in a conference last year in 2025 that I learned about this process. They literally said, we are going to stop hiring. Okay. And automate everything with AI. It will improve our margins. Okay. It is working. Amortization of intangible assets going down. It's meaningless. It's because of the acquisitions. Anyway, and the software capex. Meaningless. And same thing for the depreciation. Meaningless. Which means the total operating expenses are up 7%. Again, beautiful operating leverage. If your revenue is up 14% and your cost of goods sold plus 4% and operating expenses up 7%, of course it will improve your margins. The operating income is up 21%. And now we are talking. This is lovely. The operating margins went from 50% to 53%. 3% improvement. Life is good. Exactly as they said. So beautiful execution here. Congratulations to the management team. I like this report a lot. It's about efficiency and I like it. Okay. Now let's move down the income statement. Let me go line by line so you understand clearly what is happening. They have an interest income of something -2, we don't care. Interest expense, 70. That is up 48%. This is the cost of debt, right? I told you they increased their debt level, so you have to pay more interest on the debt. So yeah, meaningfully so. The cost of debt, the interest expense, was up by 48%. This is the cost of debt, and it will be at this range for a while now. This is not good, but to be expected. We knew it was going to increase, okay? So, if you adjust for this increased cost of debt, the income before taxes is up 17%, 17.5%. So, even if you account for the increased cost of debt, the pre-tax margins are up from 44% to 45%. The increase in margins, thanks to efficiency, is stronger than the decrease in margins because of the cost of debt. So it seems like this strategy is working. Then here is the big boy. Here is the big adjustment. By the way, I'm putting this in green because that's positive, and here in green to be adjusted because that's positive. The taxes were negative during this quarter. So of course, it will create a messy situation. The tax rate is minus 4% for this quarter in comparison to 12% last year. So if you don't change anything, you have a net income that is growing 40% per year, and the earnings per, and you are doing 6% buybacks. Look at this, 5.66% more buybacks. They continue their buyback program. So the earnings per share are up 49%. And this is what you have at the beginning of the earnings report, by the way. Look at this. Yeah, diluted EPS growth of 49%. Please don't make this mistake. It is not true, right? Because you have to make an adjustment. And now, what did I say? To be adjusted, much lower tax rate. The guidance is 18 to 20% taxes for 2026. Okay, what did I say here? Let me scroll down. Modify. Okay, I hope you see well. Look at the right. This adjustment in tax rate reflects a tax change in connection with the multi-phase internal legal entity restructuring that commenced in Q4 2025, so last quarter, and was completed in January 2026. In the Q4, they had more taxes. They had to recognize discrete tax expense of an additional $38 million related to the first phase. And they expect to recognize a discrete tax benefit of approximately $88 million in 2026 related to the subsequent phases of this internal legal entity restructuring. Don't worry, I know it's a little bit complex. Let me go slow. In 5 minutes, you will understand everything. Don't worry, I will go slow. Management excludes these discrete tax effects from non-GAAP, blah, 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 blah. Essentially, last year, so last quarter, late 2025, the company is reshuffling its internal legal structure, moving assets, intellectual property, or subsidiaries between different entities to be more efficient. Different states, different tax rates, they are moving things, moving the furniture inside the house, reorganizing the house. So the bad news is last quarter, they had to pay $38 million upfront in more taxes. But the good news is in 2026, because of how they moved things, they expect to save $88 million in taxes later this year. This was the plan, and it was what I wrote in my analysis for the last quarter. In the last quarter, this is my slide for December 2025. So last quarter, I said this. I said, yeah, please, you have to adjust this. The tax rate is especially high. For last quarter, the tax rate was 26% compared to 16% the year prior. So yeah, you had to make an adjustment last quarter because the tax rate was too high. And now you have to make the adjustment this quarter in Q1 2026 because the tax rate is too low. Okay. What do I have next? Okay. Réponse. Okay. This is in French. The net result out of this restructuring is they are actually coming out ahead by about $50 million. You have $88 million gain for 2026 and a $38 million cost in 2025, but the timing is split across 2 different years. This was the information we had last quarter. We did not know when they would have this tax benefit, but it seems like they used the entire tax benefit of $88 million in Q1 to be adjusted. Actually, I did not expect this, to be frank. I expected the company to spread the tax benefit across different quarterly reports, right? To be smooth and efficient. No, boom, in the first quarter, they made the tax benefit right away. So of course, the real tax rate is not minus 4%. It's shocking. So you have to adjust it. They had a tax benefit of $88 million. So let me add $88 million to really understand what would have been the real tax rate if we didn't have this restructuring. I hope that's clear for you. If you add 88, the tax rate goes from minus 4% to 18%. And boom, we are in the range. We are in the guidance of 18 to 20%. And now, what are the growth rates? if you adjust for the real tax rate? What if you didn't have this restructuring? What about the core operations of MSCI? Well, revenue is still up 14%. Operating income is still up 21%. The operating income before taxes still up 17%. But because you now have a tax rate of 18%, the net income is only up 10% compared to 40%. So that's a big decline. But anyway, net income is growing 10%. You continue to do 6% buybacks. So the earnings per share are up 16-17%. The core operations of MSCI, that's it. Revenue up 14%, margins up, buybacks up, so the earnings per share are up 17%. And these are the reasons why I bought MSCI a couple of quarters ago. It's an asset-light company that can grow revenue double-digit, improve the margins, and the earnings per share can grow at roughly 15% per year for a very long time. And the valuation was quite appealing. Now the stock has rebounded, so the valuation is not as appealing, but wait and see. Wait and see. Okay? So, they have something else, and now I remember what I said a couple of minutes ago. You should have a question now. If you've been following this video with a lot of attention, you should have a question. Because I told you, if you adjust for the real tax rate, the earnings per share are up 16.8%. But if you look at the earnings report, they say adjusted EPS is up 13.8%. You should have a question, why do you have a difference? Okay? Why is the management team saying adjusted EPS, if you adjust for this tax restructuring thing, is up 14%, but Christophe, you have 17%. Why is that? And I'm glad you asked. Okay, now I want to show you the last page of what I have for the earnings report. I've seen no one talk about this again. Okay. Wow, you have a lot of notes. So, okay, let me drink a little bit. I will explain. That's not complex. It's just, I'm aware it's very colorful. It's not complex. I will go step by step and I will go slowly, okay? Let me put my face here. Or maybe at the top. I want my face to be smaller than this. Anyway. First, let's focus step by step. I don't want to lose you here. Step by step, step by step. Don't look at this. Don't look at this. You have a table 10, page 18. Reconciliation of net income and diluted earnings per share to adjusted net income and adjusted EPS. Basically, what would have been the net income without the tax benefit? So what we try to do. So they start from the net income and then they get their adjusted net income. What are their adjustments? Because in my Google Sheet, we only adjusted for the tax rate. But it seems like the management is adjusting something else. Let's see. I mean, they are forced to disclose this. So, first of all, they start from a net income of $400 million, plus amortization of acquired intangible assets, plus 20, less tax impact from internal legal entity. I put it in yellow. This is what we have said before of $88 million, less income tax effect. Instead of adjusting one thing, they adjust three things. And I disagree. The amortization, what you see in purple, the amortization of acquired intangible assets, that's the amortization of intangible capex and also acquisitions. And in their adjusted metrics, they decided to touch this. I disagree. I disagree with this adjustment of amortization of acquired intangible assets. It's software capex. Don't adjust it. And what are you going to adjust? D&A? Salaries? What's next? This is why I don't like EBITDA. You have so many adjustments. I like to look at the raw data, right? So I disagree completely with this line. And I think the $20 million adjustment should not be done. And because this line is impacted, you have to adjust the tax rate accordingly. So these two lines, the amortization of acquired intangible assets and income tax effect, that's in line. That's similar, right? That's linked. You have something in purple at the end here. Adjustments related to the tax effect of non-GAAP adjustments, which were determined based on the nature of... Anyway, that's a little bit too complex. My point being, they are adjusting this, and I don't think they should adjust this. So, if I add back $88 million of taxes, then my adjusted net income is $318 million. The only adjustment I am doing is 406 minus 88. Let me triple check here. Double check, triple check. 106 minus 88. That's 318. So my adjusted net income is $318 million. And that gets me a growth rate of 10% versus what they say of $334 million plus 7%. Maybe I'm not clear, so let me repeat. With my estimates of only adjusting one thing, only the tax rate, if I make the adjustment, as you can see per this line, 28, the net income is growing 10.2%, what we just said a few minutes ago. But according to them, the adjusted net income has 3 adjustments, and it gets them an adjusted net income of $334 million. And if you compare to last year and their adjustments, that's a growth rate of 7%. I am being more bullish than the management and their adjusted metrics. The same thing is true for the earnings per share, right, on a per share metric, because they are doing 3 adjustments where I'm doing only 1 adjustment. Let me remove this. Similarly, my adjusted EPS, I'm just looking at the impact in yellow from the restructuring. My adjusted EPS is 53. 53. What we have here? Yeah, right. Diluted EPS, so you start from the high base of 5.53 minus the tax restructuring change, that's 4.33. So my adjustment, as we've seen before, if you adjust for the real tax rate of 18%, look at this line 29, we have found $4.33. Okay? If you adjust for this, okay, just for this, and you compare to 3.71, that's a growth rate of 16.8%. If you compare to the number, I'm comparing $4.33 to this metric here, 3.71, because I am not looking at this line in purple. I am not looking at the income tax effect. So the 2 adjustments you see at the right of the screen here, I'm not taking this into account. So I'm looking at the real impact of this restructuring one-off tax change. And that's it. So the real growth rate of adjusted EPS is 16.8%. But what the management says is they have found this 4.55. So in comparison to the adjustments because of last year, that's a growth rate of 13.7%. You now understand the difference between what the management says, adjusted EPS of 14%, because they adjust software capex and acquisitions, and you understand this difference with my earnings per share, growth rate of 16.8%. I think my estimate covers the fundamentals of the business better, but I'm not the CEO of MSCI, so maybe they know better, right? Both metrics are good. Whether you want to look at 14% or 70%, that's still good. But if you look at the core operations of the business and you want to cheat as little as possible, this is what you have. Okay? Now, I know some people will say, yes, Chris, but do you really want to adjust the tax rate? Because part of the restructuring process was to improve the taxes. I told you before, this net result, $88 million of gain minus $38 million of cost, that's $50 million. So maybe you don't want to reduce the tax rate by 88. Maybe you don't want to adjust 88 because there will still be a gain, right? I could understand this because overall for 2026, the restructuring process was here to gain $50 million in taxes. So maybe it's right. Maybe they are right. So I should not adjust for 88, but I should adjust for 50. Only 50 maybe. I mean, you can make all these kind of adjustments. If you put 50, then the tax rate is not 18%, it's 8%. And if you really adjust for this, the net income is up 23%, earnings per share are up 31%. I'm not a fan. I prefer to completely be conservative, and let's assume there is no improvement in tax rate. Business as usual. So I'm not a fan. I prefer to do it my way of considering taxes are the same without the restructuring. And we are in front of a beautiful business that is getting more efficient over time. The taxes are reasonable at 18%. Net income is growing at 10% per year. They are repurchasing 6% of their shares every year. And earnings per share up 16-17%. I prefer to do it this way actually. So you have understood all the adjustments, wonderful. Now I have a few comments and later we will check the earnings call together. A few things I want to share with this earnings report. One, they are focusing on their crown jewel, the index segment. The index segment is the most profitable segment and it is growing meaningfully and reaccelerating meaningfully. Two, markets are going down and the assets under management, the AUM, is going up. So when markets rebound, index will grow immensely. It is extremely bullish for MSCI. Three, the index segment improved margins. This is not what they planned, but we like it. The analytics segment decreased margins, so they did not deliver here. The ESG segment improved margins. They did deliver. And for the private assets, they decreased margins. They did not deliver. In the future, margins will continue to trend higher. This is what I believe. I think margins will have a lot of potential in the future to go up. The cost of debt is impacting the overall profitability, but for this quarter, efficiency is stronger. Despite more interest expense, margins are going up. You have a one-off tax benefit, and I expected the stock to go up because of this. Because people don't read at the core data and the adjustment. In reality, the earnings per share are not up 49%, but plus 16-17%, still very strong. I don't expect major acquisitions in the future. The capital allocation is very clear. They want to do a little bit of dividends and buybacks when the stock is cheap. Small, tiny acquisitions here and there, but no massive acquisitions. Just buybacks, buybacks, buybacks. Guidance is unchanged. More capex is expected in the future. Is the capex going to grow or just a one-off to implement AI? I want to know what they say about the call about AI and capex, because the capex may maybe grow in the future. Maybe it will grow in the future and I don't know why. Okay, so let's see if they explain. I expected a stock price or jump of 5 or 6%. Based on everything we've said today, based on all the numbers, the reacceleration of the core segments, the new slides, their bullishness, the best quarter, AUM going up, I expected the stock to go up. I like this report a lot. I could have expected the plus 5%, plus 7%, and the stock went up 5%. So I agree with this move. It's in line with what I expected. The quarter was very strong, even if you adjust for the tax benefit. Now let's see what the management team said on the call. I want to go on investor relations on Fiscal AI. This is what Fiscal AI is so great, because you have everything is in one mega app. So please click my link in the description and create an account. It's a lovely website. I want to check the transcript. I will put 1.25 speed because it's 1 hour long. So they talk slowly, don't worry. And I will comment on this earnings call, because I will have some additional things to share. I did not listen to the call yet, so it's a full reaction time for you. So listen to the call with me, okay?
Good day, ladies and gentlemen, and welcome to the MSCI First Quarter 2026 Earnings Conference Call. As a reminder,
Okay, at the beginning you have the disclaimer, as always, like at the beginning of every earnings call. I want to go directly to the prepared remarks from the CEO, and then there will be questions from Wall Street analysts.
Thank you, Jeremy. Good day, everyone, and thank you for joining us. MSCI's first quarter results affirm our foundational mission-critical role in global investing, while also showcasing the highly diversified nature of our business. Our key financial metrics included organic revenue growth of over 13%, adjusted EPS growth of nearly 14%, adjusted EBITDA growth of almost 19%. We remain long-term believers in the MSCI franchise, and we are committed to maximizing value creation through the disciplined deployment of our excess capital. Between January 1st and yesterday,
okay, they start right away with the buybacks. Fair enough.
We repurchased more than $464 million of MSCI shares at an...
Okay, yeah, you have some differences between $400 million or $414 million or $464 million because of the timing, right? For the first quarter, it was January 1st, for example, to March 31st, 31. And what they say is yesterday, so April 20th. So they continue to do buybacks for Q2. Anyway, that's roughly $400 million.
An average price of about $556 per share. In addition, we recently completed 3 very exciting and highly strategic small bolt-on acquisitions in key growth areas.
So we already talked about 2. There is another one, maybe an ESG.
Our Q1 operating metrics included total run rate growth of nearly 13%, fueled by a record asset-based fee run rate of $872 million, growing 25%, and recurring subscription run rate growth of 9%, fueled by net new recurring subscription sales of $39.6 million, growing 52%. It was our best first quarter for net new recurring subscription sales since 2022. The retention rate across all MSCI product lines was 95.4%. Our increased business momentum is starting to reflect the relentless adoption of agentic AI in everything we do, ranging from how we capture data and build models and platforms, to how we launch and market our products, to how our people work every day. This momentum cuts across geographic regions, product lines, client segments, and asset classes. We did well in all regions in Q1, with Asia Pacific a particular standout. In fact, we posted our strongest ever Q1 on record for recurring sales in APAC at $15 million, up 46% from a year earlier. Across product lines, MSCI has built our momentum through sales of both newer and more traditional solutions. In Index, for example, subscription run rate growth returned to double digits in Q1.
Return to double digits. We have seen this in the slides. In the past, it was, 9%. And finally, the green line here is growing back double digits. The last time we had this was in 2023. So more than 2 years ago.
At 10.7%. And we achieved a record level of Q1 recurring sales at nearly $33 million. These results were driven mainly by our market cap indices, but we also deliver impressive growth in custom indices. With more than $21 trillion in AUM benchmarked to MSCI indices, the ecosystem around our products is scaling to new heights. This includes $7.4 trillion of indexed equity AUM benchmarked to MSCI indices, comprised of $2.4 trillion in ETF products and $4.9 trillion in non-ETF products. Q1 was our best quarter since 2023 for traded volumes and run rate from listed futures and options contracts linked to MSCI indices.
They are very bullish. They already mentioned AI. They say again it's the best quarter, recurring growth is reaccelerating. The prepared remarks are very bullish.
This further reinforces the power of our ecosystem and our shared success with the MSCI exchange partners, including our new licensing agreement for options on MSCI indices listed on the New York Stock Exchange. AI is helping us capitalize on these trends by offering more flexibility, faster customization, and greater interoperability. For example, our new Index AI Insights connector makes it easier for clients to answer questions about our index data and methodologies using their preferred AI large language models, such as Claude and ChatGPT or on MSCI One.
This is exactly what we wanted. We want them to be bullish. We want them to mention AI. We want them to mention Claude and ChatGPT. MSCI One is their mega app they built in 2022. This is why the software capex has been increasing, the orange line in the past, massively, because they decided to build a mega app for index and analytics and ESG and private assets, like a mega platform, standardized platform for all their clients, so they can cross-sell between different clients. A client may need analytics. Why don't you cross-sell the ESG analytics and something else? So better integration, standardization, cross-selling, upselling. So they are building their mega software, mega app. And apparently, in this mega app, you now have access to ChatGPT and Claude integrated to fetch data faster, to be faster, more efficient. I want them to repeat this as many times as possible.
Hundreds of clients have used Index AI Insights since our launch in late February.
MSCI also is very recent, in late February of 2026. So it's only 1 or 2 months old. It's only recent, okay. This is maybe why they added new slides. It's not because they want to show off, it's because it's new. Maybe.
MSCI's recent acquisition of Compass Financial Technologies, a Swiss-based provider of index calculation services, extends our customization capabilities into additional asset classes, such as commodities, digital assets, and equity derivatives. Meanwhile, in private capital solutions, we deliver recurrent net new sales growth of nearly 44% in Q1, while driving adoption of both newer and established solutions. Some of our reimagined and innovative new tools include daily private valuation indices and benchmarks for private equity and private credit. MSCI's AI capabilities in private assets have increased dramatically over the past year, including a new connector on Claude linked to our private capital intel fund benchmarking. We are helping allocators streamline the due diligence and evaluation of private fund managers at scale with our private asset due diligence platform. Our recent acquisition of Vantager, a platform built entirely on AI, accelerates our ability to help clients perform better due diligence when investing in private markets. Likewise, our acquisition of PM Insights earlier this month will help us deliver secondary market pricing, liquidity, and reference data, which will support more robust portfolio construction and the development of indices and analytics solutions.
So they mentioned first their biggest acquisition of $40 million. They mentioned their second acquisition, PM Insights, but they said they did 3 acquisitions. The first acquisition was meaningful, $40 million. The second acquisition, they did not disclose the price paid. They did not disclose the revenue, so it's insignificant. We can guess that the third acquisition was even smaller than the second one, and they are not even talking about the third one. So yeah, it's a tiny acquisition, I suspect.
Turning back to MSCI's Q1 performance, in analytics, we drove recurrent net new subscription sales of $8.2 million, up nearly 55%, reflecting large wins and renewals of our equity offerings and enterprise risk tools.
Good.
These wins underscore the continued innovation of our factor capabilities, such as our next-gen models and the release of basket-building solutions for the market-making and trading community. They also demonstrate our advancements across total portfolio solutions, including our unparalleled private asset coverage, as seen in our new private credit risk models. Among client segments, MSCI has an especially strong quarter with hedge funds and traders. Among hedge funds specifically, we posted subscription run rate growth of 17%, along with our highest ever level of Q1 recurring net new subscription sales at roughly $12 million. These results were driven mainly by index and analytics. These wins included a 7-figure index rebalancing deal with a top global hedge fund. In analytics, hedge funds are also licensing our crowded trade datasets to support their alpha generation. Among banks and broker-dealers, we delivered subscription run rate growth of almost 11%, along with our best ever Q1 for recurrent net new sales at nearly $11 million. Shifting to asset owners, MSCI achieved subscription run rate growth of nearly 10%, driven by private capital solutions and analytics.
This is good. The asset owners segment is quite important because it was decelerating in the past. Now they are growing nearly 10%, so let's say 9%. It is good. It is good. It is something that has to be monitored, this line.
As more pension funds diversify into private markets, we see growing demand for our total portfolio solutions and private asset tools, including our tools for benchmarking and for transparency. Moving on to asset managers, we posted subscription run rate growth of over 6%, along with nearly 11%.
Similarly, this line is important. Asset owners and asset managers, two lines that are extremely important. And this is decelerating. Growth rate of 6%, along with nearly 11% in recurring net new sales. Not great. I want this line to be at 10%. And it's not at 10%. It is decelerating. It was like a 7, 6, 5, and then 6 again. It's not great. This one I don't like.
7% recurring net new sales growth, including, notably, a strong growth in analytics and a retention rate of close to 96%. MSCI is executing on key growth opportunities for the asset management segment, including advanced datasets, private assets, total portfolio solutions, and active ETFs. Looking at our Q1 performance as a whole, we once again demonstrated the benefits of our all-weather franchise, our client segment and product diversification, recurring revenue financial model, and the growing liquidity and scale of the investment ecosystem linked to our indices and our IP. Our ongoing technology and AI-driven transformation will strengthen these advantages. To help us lead that transformation, Dinesh Gupta joined MSCI last month as our new Chief Data Officer and Global Head of Operations. Dinesh came to us from Goldman Sachs, where he spent nearly 3 decades and held leadership roles spanning multiple business lines, including asset and wealth management. Dinesh served as Global Head of Data Engineering at Goldman, and he also led the organization responsible for building agentic AI platforms and machine learning capabilities across the whole firm. He is ideally suited to help MSCI strengthen our comprehensive data strategy, reinforce our technology and AI-first mindset, and accelerate our transformation.
I mean, they are embracing AI full force. Hiring a guy to have an AI agentic platform in full force. How many times do you want them to say AI? I think that's enough for today. I mean, they will continue to say AI everywhere, but yeah, quite interesting. Now the CFO will talk, but I think I will skip this part. We are growing our market share and expanding our influence in the increasingly AI-centric investment industry. They will talk about the metrics, but we already talked about metrics, so I don't want to waste your time. Okay, we have already seen this. The index retention really high. Record inflows. To put that in context, we had inflows of $60 billion in the past. Now that's $100 billion. We have talked about this in the past. Page 17. Global investors continue to deploy capital into us, into our ETF. European strong performance, European indices. We see attractive opportunities in the European market. Okay, ETF analytics performance wins. The analytics revenue growth was 10%, although this reflected a higher volume of implementation recognized in non-recurring revenue. For Q2 2026, we expect analytics revenue growth rate to be 5%. They give a guidance for the quarter.
For Q2 2026, we currently expect analytics year-over-year revenue growth to be roughly 5% for the quarter. In private capital solution.
Okay, that's strange. So if I go to segment and KPIs, I can show you visually what it means. This is what we have. Yeah, we said analytics revenue was growing and we didn't know why. They said higher volume and also a non-recurring thing. For the next quarter, expect to drop to 5%. Okay, I'm not surprised, but I would be surprised if it went up. It would have gone up. Yeah, it will grow 5%. Okay, they already give the guidance for the second quarter. Fair enough. What else? Let me skip some parts. Okay, we've seen strong momentum everywhere, in real assets everywhere, blah, blah, blah. Our capital position remains strong. We have a lot of cash. We can do more buybacks. And we did the acquisition of Vantager, Compass, and PM Insights. Oh, that's the third acquisition. Okay, Vantager. It was a rename, that's why. Okay, no, my bad. They mentioned the 3 acquisitions. They mentioned this acquisition called Vantager, this acquisition Compass, this acquisition PM Insights. But in the cash flow statement, they only mentioned Compass. Anyway, you have understood some acquisitions, not really meaningful to the revenue. It's tiny acquisition here. Okay. So yeah, my bad. It was a big acquisition, Vantager, that they mentioned. These 3 acquisitions add a relatively modest contribution to run rate and ongoing expenses. On guidance, we updated our outlook for depreciation and amortization by $5 million to incorporate the impact of these acquisitions. Our guess was good. We said this line in yellow went up by $5 million because of potentially more acquisitions. Good guess. Okay, and we have a tax rate that is unchanged for 2026 between 18% and 22%. The free cash flow outlook is unchanged. We start strong. We reaffirm that today in the AI first economy we are strong. Blah 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 blah. Q&A session, please.
Your question, please.
Yeah, hey, good morning, everyone. Just want to talk about the, sales momentum a little bit here. I mean, the first quarter had a choppy ending with all the volatility in the markets in March. So good to see still good momentum there. So just wondering, did anything slip given the environment, but more importantly, given that the second quarter is generally a more important sales quarter for you? Any kind of insight of what you're seeing so far, in particular in index analytics? Thanks.
Hi, Alexa. Thanks for the question. Except for a slowdown in dialogue and presentations and obviously demos in the Gulf region, the countries in the Gulf, the Arabian Gulf region, we have not seen any effect of the Iran war anywhere else in the world. It has obviously been a bit surprising to us, but we have not seen clients pull back. We have not seen clients delay decisions. They've been operating on a business as usual. And that was at the end of March and also in the first 3 weeks of April.
Very good. That could have been a risk to monitor in 2026. They clearly say no, business as usual. Next question.
Your question, please.
Thank you. Good morning. I guess, Henry, I just wanted a little bit more color. I mean, these are obviously some impressive net new sales numbers out there, especially in this environment where we all perceive, your main customers to be budget challenged. Are you taking share? Are you just taking more of the wallet? Can you talk a little bit about some of the product areas, innovation, and where this growth is coming from?
Yeah, so Manav, in our own internal discussions and analysis, we have not seen, the operating environment and the end markets that we're serving have not changed for the last few quarters. Have not changed almost at all. A few things a little better, a few things a little worse, but they have not changed. But what has changed in terms of this performance of Q1 and also the past performance of Q4 of last year is a stronger execution across MSCI in 3 big categories. The first category is selling what we currently have, the products that we currently have, more aggressively, more creatively, more energetically across all client segments and all regions of the world. Number 2 is a significant acceleration of the launch of new products, or I should say the start of an acceleration in the launch of new products. We launched an equal number of products in Q1 as we did in the full year of 2025.
Whoa. And it's because of AI. They've been talking about this trend for months now, almost 1 year. AI will allow MSCI to create more custom indexes much faster, like way faster. Instead of, weeks, you can do it in 1 day. So yeah, you're faster, you're delivering faster, and they created an equal number of products in Q1 as they did in 2025 in the entire year. Everything will accelerate with MSCI. I think the revenue will accelerate because of AI.
And number three, a significant acceleration in adoption of AI tools in everything we do, along the lines of what I said in my prepared remarks. So those three areas have helped us increase our recurring revenue, have bigger penetration, take market share away from competitors, especially in the sustainability and climate area, and grow faster. And we believe that, as we have said before, that Q3 was a little bit of the bottom. Q4 was better. Q1 is better relative to obviously expectations, and we think we're on a growth path here.
Thank you. And our next question comes from the line of Toni Kaplan from Morgan Stanley. Your question, please.
Thanks so much. I was hoping if you could talk about whether you've seen sort of any uptick to revenue specifically related to AI. I know you talked about sort of the products built on AI, and any quantification around expense savings with regard to AI. Thanks.
Yeah, Tony, basically every new product we're launching has an AI component to it. Some of them are, a few of them are AI native, some of them are AI powered, and some of them have some AI enablement. So depending on the product and the area, the importance of AI is very big in the AI native ones, or just the ingredients that go into the launch of the product. So that's pretty much across the board in any new product. So therefore, we have been tracking last year on the revenues associated with quote unquote AI products. And we keep doing that, but it is almost irrelevant right now because everything that we're launching has an AI component to it. It's just a matter of degrees. The second part of your question is efficiencies. We are seeing significant early efficiencies in the use of AI across the whole board. It started in earnest in AI data, applying AI to the data capture and the data development in private assets and in sustainability and climate. That has accelerated significantly to the point that it allows us to dramatically increase the amount of data gathering and data development with the same level of headcount that we have, rather than adding headcount.
So they don't want to increase the headcount. They don't want to hire a lot of employees. With the same level of headcount, same number of employees, they can do more. This company is telling you exactly they are going to be more efficient in the future, better margins.
We're beginning to see significant productivity as well in software development, new software applications, and we haven't yet started rewriting the current software that we have in terms of either production or applications with AI, but that will be a big project that we want to get into in the near future. And then thirdly, and also very importantly, we began to use AI across the board in the development of models and methodologies. So, for example, in custom indices, that we're ramping up, as you know, the development of the custom index capabilities. We're now using AI, obviously managed and monitored by our humans in our research department in the creation of custom indices at a much faster speed than we've ever done before. We always using AI for analytics models as well, and we just revamped the entire sustainability rating system, ESG rating systems, using AI, and that's going to be, it's in the process of being relaunched. And that's going to give us enormous productivity and scalability.
Of course. If you want to create a custom index, now they made an acquisition about the commodities, derivatives, the crypto. If you're a fund manager, you invest partly in stocks, partly in crypto. And you want a benchmark. You want a custom index to benchmark your performance. Let's say that's 50-50. 50% of your fund is into stocks, 50% crypto, Bitcoin, Ethereum, anything. You don't want to compare your performance with the S&P 500. You want to do half S&P 500, half Bitcoin, for example. You have to create this custom index. And as they say, it's much faster. If you integrate ChatGPT and Claude, maybe in the future, you can write a prompt on the AI MSCI One platform. create a custom index, 50% S&P 500, 50% Bitcoin. Boom! In 2 minutes, that's done. Or I don't know, a couple of hours. One day, that's done. Maybe that's how easy and how fast things can be in the future. And that's quite easy to implement. Once you plug in Claude and ChatGPT, I mean, they can do it in 2026. Creating custom indexes much faster.
Tony,
and by the way, I would just add that from a year ago to now, the use of AI across our over 6,000 professionals in the company has increased dramatically. About a year and a half ago, we made AI a condition of employment at MSCI. We started giving tools and training and demos and created champions and all of that across the whole company. We now have the vast majority of MSCI employees using AI models every single day that they're working.
That's huge.
Andy?
Yep, Tony, this is Andy. One other point to highlight, which adds to the benefit side of the ledger from AI, is we are starting to see clients that are interested in licensing more content, getting access to more content for AI-driven use cases. We think that's early days, and that's potentially a huge opportunity for us and something we get very excited about, given the unique content that we have. So that added to all the points that Henry highlighted, reaffirms that AI is definitely a boon for us.
Okay, next question.
Thank you. Your question, please.
Hi, good morning. Thank you for taking my questions. So analytics revenue was up over 10% year over year, and Andy, you also mentioned that you had some pretty strong non-recurring revenue related to implementation. Could you please talk about the outlook there, in specific for implementation, and then how high is the correlation between the strength of your index business and the strength in analytics in the first quarter? Thanks.
Sure. So a few points there. Maybe let me talk first about the momentum we're seeing in analytics, which definitely has been encouraging. We continue to have strong success with our equity analytics, and we had some big wins in the quarter, and we also had some nice wins on the multi-asset class side. So that the success that we saw in analytics in the quarter was across multiple fronts. We're seeing strength across client segments. We continue to see very strong growth with hedge funds. We actually had 14% growth in analytics with hedge funds. We're also seeing strong momentum with banks, where we had 10% growth, and asset owners also are a big win area for us, which Henry highlighted earlier. A lot of that is enabled by our total portfolio capabilities, which really lean on our differentiated private asset content. And so we saw 9% growth with asset owners. So good momentum across client segments. Our factor franchise continues to get a strong boost within that hedge fund community, but excitingly, we are seeing traction outside of hedge funds. So had some wins with traditional asset managers as well. And so we're encouraged by the momentum across analytics, and you see that in the run rate, where we've been kind of steady in the high single digit type area. Your comment about analytics revenue growth was that there are some unique factors at play in the quarter. So I would highlight that we did have a large implementation that was completed during the quarter, and hence you saw some meaningful non-recurring revenues within analytics, which drove the overall revenue growth to be slightly above 10% within the segment.
Yeah, that's here. Analytics. You can see here the recurring subscription, that's up 7.9%. And the non-recurring went from $2 million to $7 million. So it is boosting the growth rate from 7.9% to 10.3%. So the real one should be 8%.
As you've seen in the past, there can be some lumpiness with regards to when those implementations are completed and the comparisons to the prior year period or the comparable period. And so in Q2, we do expect the revenue growth to be more mid-single digits, so closer to 5% within analytics. Beyond Q2, we do expect the revenue growth to track much more closely to run rate growth. So looking forward longer term, we think run rate growth is a good indicator of the revenue growth. And as I alluded to, that's an area where we see good momentum and strong traction. Your question about correlation with index, listen, there are dynamics that are overlapping. So within the trading and hedge fund community, our content sets are very complementary there. We've seen strong traction both in analytics and in index within that client segment. We do see also general environmental factors at play that drive both. And as you can tell by the results, we had a good quarter in index and a good quarter in analytics. So there is some correlation there. But there are also different dynamics across different parts of the business. So I'd say it really depends.
Next question.
Thanks for taking my question. So really strong subscription run rate growth in hedge funds, asset owners, and broker dealers. But I wanted to focus on the asset manager, where it moderated a bit from 7%, I believe, last quarter to 6%. Can you just talk about the puts and takes there? How should we think about that momentum in asset managers going forward? Thanks.
Yeah, that's an important line because this part about asset managers is a cash cow. You want this to grow. And this is a good question. This is a sneaky question because it's just a small, tiny question about a small line in the report. Not even in the report, just in the prepared remarks. But it's an important one. So congratulations to this analyst for asking this.
Yeah, sure. And listen, there are some FX factors at play with the growth rates in any given sector. We actually have seen good momentum, and we've seen pick up with asset managers in spots. As Henry alluded to earlier, we are benefiting from the innovations that we've made, so the new product development, as well as just more generally enhanced execution, and that includes how we cover our asset manager clients. The success was multifaceted, so we did have success in licensing more content and broader usage of our tools across asset managers. For many of particularly the larger clients, we've taken more of an enterprise type approach to how we work with them, and that leads to some very attractive additional licensing opportunities, and it also leads to more stability in the segment and with the retention rate, as we alluded to, saw a very strong retention with asset managers in the quarter. We from a geographic standpoint, we saw good momentum in the Americas and good momentum in APAC. And as I alluded to, we've seen it both in analytics and index. And so maybe just to double click on each of those quickly. On the index side, we have delivered more solutions beyond the broader licensing that I referenced earlier. We've released content sets that are helping these clients in the portfolio construction process, but also in the sales enablement process, meaning how they communicate to their clients and how they think about launching new products.
They are not answering the question.
We also have solution sets that are getting traction for active ETFs, and then more generally supporting indexed investing in many forms and fashions. And so we're seeing a number of areas of growth across index for asset managers. And then, as I alluded to in the last question on the analytics side, listen, we've had some big multi-asset class wins, and we've also seen some traction with our factor franchise. And so it's overall encouraging. I think a lot of it, as Henry alluded to, is really driven by our efforts and our execution on that front. And we continue to view asset managers as the key and core client segment for us.
No. Bad answer. Why is this segment growing less and growing 6%? Are you decelerating? What are the factors that are implemented to maybe grow again? They say, we see a lot of opportunities. As you can see, our other segments are growing nicely and we are getting more traction, so it should be fine in the future. Is that it? So why can't you grow more? I don't like this. New product development, the success is multifaceted. Okay, enterprise approach, very attractive additional licensing opportunities. So they sound bullish, but they say nothing. Strange. No meaningful areas of development here. They literally say a lot of words, but no meaning. No, that's bad. Something to monitor for next quarter. I mean, I would love to ask them again a hard question like this and get a better answer. Interesting. I don't understand what are their opportunities. Do you have seasonality? What are you implementing to grow this segment again? Is this normal or not? Are your competitors having the same issues and reducing the growth rate for this segment? Or are you the only one that is suffering? Is this an industry-wide problem or only you, MSCI? Plenty of hard questions for them. I don't like this answer. Anyway, next question.
Thank you. Maybe just talk a little bit further about a little bit better numbers in sustainability and climate there. It's obviously nowhere back to where it was before. It seems like the environment for that has dramatically changed here in recent quarters. But just talk what's a little bit better momentum there, if you would, please. Thank you.
So, Craig, the way we look at it, it's important to start by differentiating sustainability, or former ESG, right? Sustainability from climate. They have been a little bit linked in the past not because they have similar dynamics or supply and demand or competitive landscapes, but at least because sometimes the sales that we did were sales that were in one package. We were linking them into one package, which we are increasingly separating. between the two, because we believe that sustainability, we will continue to sell and sell well, but there is a lot of rationalization of cost, and there is a significant market share that we are taking away from competitors on sustainability. On climate, we're pretty hopeful. We're cautiously optimistic that at some point it will reaccelerate, especially in physical risk. So this past quarter, we had an important win, which was Deutsche Bank, the central bank of the central bank of Germany. Was not Deutsche Bank, but the central bank of Germany was subscribed to a series of climate risk tools from our side on behalf of the European Central Bank system, which incorporates all the national central banks. So we're very encouraged by that because it was a competitive win. We were selected as the best provider, and now obviously we got the work of penetrating each one of the national central banks. So that tells you how important they view climate risk and how important they view the MSCI offering. So we continue to focus on the transition elements of climate change, but very importantly, we're now more and more focused on the physical risk part, and we see increasing demand there. We believe that the Iran war and the energy shock that has come out of that is going to underscore significantly the energy transition that a lot of countries need to make to ensure less dependence on oil and gas coming from the Gulf. And that's going to bode well for a lot of our tools.
Of course, a big partnership for ESG is from Europe, our continent, our old continent that is more focused on ESG than making profits. So I'm not surprised. I'm not surprised that a big deal they are signing is in Europe, especially Germany. So yeah, I mean, green countries over there. Okay, interesting. I'm still standing on my opinion that as long as you have this administration in the US, ESG will not be a focus. So maybe in a couple of years, when you change the administration in the US, maybe you have a president that likes ESG a little bit more. I don't know, nobody knows, maybe more, maybe less. But if you have a new president in the US, a new administration that likes or loves ESG, it will be a big push for MSCI. For the moment, I don't see this segment growing. They will sign deals here and there. I don't see this segment growing. They already talked about getting more efficient, right? Rationalization of costs. So they reduce cost to improve margins. They play defense. On this one. Next question.
Your question, please.
Hi, guys. Want to jump into the active ETF business. Seems like from our data there was some pickup in active ETFs more broadly, that these seem to be doing pretty well as sort of a category. Maybe you could highlight what that business looks like, how that may have helped your fund flows in 1Q or not, and then anything we should understand about how you guys participate in that business and how that flows through your numbers. Thank you so much.
So we're very excited about that part of our business. Very excited, and there are a number of reasons why that's the case. The first one is we believe that this is an area of significant expansion by the active asset management industry, right? That a lot of what they're getting hit in outflows in mutual funds and other forms of active management, they can latch on to active ETFs and revive growth. And this is a client base that we know extremely well. They recognize our data sets and our indices extremely well, and therefore we can be very helpful to them. Number two is it's important to also recognize that something like 70-80% of the active ETFs that are being launched have some element of systematic investing or index investing in them. And they're not pure play stock picking ETFs like some of the mutual funds could be. So that is fertile territory for MSCI to be of significant help in terms of the underlying database and the organization of the database, to the indices that are built on the database, and then to the quantitative tools that can be applied on top of the indices to do overlays that are more that are actively managed on that. So we're very bullish about that. And then thirdly, of course, that our role in this industry on the passive side is significant, as you know, and that is and a lot of our clients are coming to us to help them on the active ETF because of our brand and the trust on our database and our indices and our methodologies in order to build this active ETF business. So we're very hopeful that will be a growth area for us on the more challenging part of the active managers around the world.
Yeah, Alex, just to answer the part about where it shows up in our financials. Firstly, I would say we are very actively used as a benchmark on active ETFs. That is something that oftentimes, as you know, is not a new sale for us. So if a client is licensed already for the module, when they use this as a benchmark on the active ETF, that's not going to be a new sale for us. But to the extent it is something that's, as Henry said, helping with the health of the asset manager, helping them grow, that can lead to additional sales for us. As Henry alluded to, we do also license additional content sets. So we have some specific content sets like our index universe data, but also broader content sets that can be used as part of the portfolio construction process, be used for overlays, risk management, as part of our clients' active ETF management. That's an additional module license for us. So that's on the subscription side. And then we have launched our active financial product license. And this is where you've heard us talk about in the past. We can do more for the client and be an integral part of the overall portfolio management, if you will, which is the index and calculating the index on an ongoing basis. And that can translate through to ABF revenue. And so we can benefit both on the subscription side and the ABF side. It's very early days, so it's small for us. As I said, we are getting good traction as a benchmark. We've had quite a bit of success early days in licensing additional content sets, but we think the opportunity is much bigger going forward, as Henry alluded to help on both the ABF side and the subscription side.
Okay.
Thank you. And our next question comes from the line of Faiza Alwy from Deutsche Bank. Your question, please.
Yes, hi. Thank you so much. I wanted to ask about the strong growth that you saw in custom indexes. And I'm curious if it's driven by just your ability to process, things faster, or is it more a function of kind of end market demand? Just trying to understand, the sustainability of the, just the higher growth that you saw this quarter.
Good question.
So basically, let's start with the end market demand. In systematic investing, and a big part of that is index investing, we have the vast majority of the historical work that we have done has been on market cap exposures. And that is, give me the market cap of your emerging markets, give me the market cap of Japan or Europe or one way or another. What is now happening is that the door is now wide open to do systematic investing and rules-based investing and index investing in what we call non-market cap, which is, give me a portfolio or an index of all the securities, equity securities in the world that have low volatility, high quality, high ESG ratings, low climate risk, or whatever. You can see, the flavor. So there is an investment thesis behind that, not just a market exposure, and therefore there is incredible growth, in equities. We now see it in fixed income, and we're even getting requests about that in private assets like private credit or private equity. So therefore, we're uniquely positioned to benefit from that, because not only do we have the index universe, the index methodologies, and a great index brand, but we have all the other ingredients to provide that. We have the factor models to create factor, the compositions. We have the ESG ratings. We have the climate exposures. We have the thematic scores. We know that in which we can put everything together in building people an index. So some of that gets translated into a standard index that we create or an off-the-shelf index that we create, but the vast majority of that is coming into a form of custom index for either active management, for active ETFs, for passive management in ETF or institutional, for structured products, for an over-the-counter swap, an over-the-counter option in a structured product or a swap. So
this is why they are promoting the custom indexes so hard, and this is also why they are making these acquisitions to have more data, a little bit of crypto, commodities, derivatives, because they want to offer a broader range of products to create your own custom index. I think this is the reason why they are doing these acquisitions.
So the demand is very significant, and therefore we've been, as you have heard us say in the last few years, we've been ramping up the ability for us to meet that demand, and that comes in 2-3 components. The first component, which is the workflow application to help people and help us design these indices, and that's the acquisition of Foxberry. The second part is, once you have that workflow application and you design what you're looking for, how do you link that to an industrial scale production environment in which you have tens of thousands of custom indices being produced safely and with high quality, and we've done all that work already. And then the third component is, okay, how do we accelerate the process of creating the methodology, the index algorithm, and we obviously were doing that with humans in our research department, and we're now doing that with AI to help accelerate that. So the demand is there. We're meeting most of the demand, but we're leaving some money on the table. And with all this improvement in these 3 areas, we're now well positioned to capture, the vast majority of this demand in the world, and we're very uniquely positioned to achieve that.
Very bullish to grow the index segment, the cash cow segment in the future. Very, very bullish to improve margins. and you don't need humans to do this. Obviously, we were doing that with humans. Now we're doing this with AI to accelerate that with a lower cost. Next question.
Your question, please.
Hi, this is Anna on for George. We saw very strong AUM growth of ETFs linked to MSCI indices this quarter, especially in developing market, ex-US, and emerging markets that's over the period of time. And can you provide more color around the momentum behind the international inflows outside of the US? How do you see the trends going forward? And additionally, do you expect the trends to drive broader subscription growth opportunities for you going forward, given MSCI's unique exposure to international markets? Thank you.
Sure. Yeah. So as you alluded to, we have a unique and differentiated franchise in ex-US markets. And if you look over the last 10 years, we've captured about a 35% share of ex-US equity ETF AUM. And that sustained leadership is really supported by consistent inflows, strength of our comprehensive offering, our strong position with the asset owners of the world, and the fact that we really have fit-for-purpose indexes tailored to whatever need our clients need. And so we feel very strong about the power of that franchise. You have seen, if you look over that 10-year period, you've seen for most of that period, meaningfully outsized flows and outperformance of the U.S. market. We did okay. We did fine during that period. But what you've seen over the last 18 months, so really the last year and a half, is you have seen a rotation take place and start to take place into international equity, so non-U.S. equity exposure. And clearly that has been a big benefit for us. We saw tremendous inflows throughout last year. We saw record inflows into ETFs linked to our indexes in the first quarter here, so north of $100 billion. And importantly, we are capturing a significant percentage of the market share of those flows, which I think speaks to the strength of the franchise. The other stat, which I would highlight, and I mentioned it earlier, is within the European listed ETF market. So these are ETFs that are listed in the European market. We have a very strong position. So we captured 40% of flows into European listed funds within the first quarter here. We also, by the way, had very strong flow capture in the U.S. for international exposure products, but Europe has been a continued area of outsized strength for us. And that is something that is helping to fuel the broader ecosystem of products for us. So the growth in AUM in European listed ETFs, but also ETFs more generally, is part of what helps fuel the opportunity with the trading and hedge fund ecosystem. It's something that drives more demand for clients to create new ETFs based on our indexes, and obviously helps in the derivatives, both over the counter and listed markets. And so it's an important point of strength for us. I don't want to speculate as to what happens going forward here, but given many of the fiscal and geopolitical dynamics at play, we have seen sustained momentum of outsized growth into international exposure areas, and that's a huge opportunity for us. We've got an all-weather franchise that can benefit in all environments, but this environment is one that creates numerous opportunities across different product areas, different client segments, and different geographies for us.
A lot of words just to say, we saw a lot of inflows of capital, especially in Europe. And maybe it will continue in the future. We are not sure. But given the geopolitical play, maybe. A lot of words just to say this. Okay.
I normally say that we're only getting started in the indexed investing world. I normally say that we're only getting started.
Why don't...
This environment is one...
I normally say that...
I'm no longer in orange. Let me... I know. Okay. Let me refresh the page. I normally say... I will come back to this. Okay, I'm back in orange. I can highlight this in orange. By the way, I'm following the script in orange, but I would love to have this feature inside Fiscal AI. If anyone watching my video works for Fiscal AI or has any contact, please, I want to click on a button and it will follow where we are on the script in orange, because now, for you, my audience, I'm following with my mouse the sentence that is being said in real time, so you can follow at the same time. But I would love to just be automatic and chill, right? So please, anyone watching my video, if you work for Fiscal AI, it's a small fix to just have this automatic highlighting in orange. Okay.
I normally say that we're only getting started in
I mean, it will help me and it will help all the other people that want to just follow these earnings calls.
Indexed investing world and in this case, the ETF world, because the only thing that has been largely capture and conquer is market cap exposures. And so when you think about the non-market cap investment thesis, which is the vast majority of the investment process worldwide, is being systematized, is being turned into rules-based, just like this active ETF that I was mentioning. And there is now a revolution going on in fixed income as well, and in commodities, and in equity derivatives. And this acquisition of Compass Financial that we made is going to help us dramatically penetrate these other asset classes like commodities, creating indices and systematized structures for commodities, for cryptocurrencies, for other digital assets, and for equity derivatives and the like. So I want to make sure you pay attention to that acquisition, because it's going to open up a lot of new doors for us. And by and large, we are by far and above the provider of choice of these custom indices across the board. And that's been the strength of our fixed income, the fixed income ETF franchise, linked to MSCI indices, is being not the market cap, fixed income indices, but the non-market cap, which is there's an ESG overlay, there's a climate overlay, there's a factor overlay, and you're seeing that growth. And lastly, what I want to reinforce what Andy was saying, which is that the two big ETF markets in the world are the US and Europe. And our presence in Europe is $1 trillion, $1+ trillion out of the $4 trillion. We're extremely well positioned, capturing a significant amount of the flows there, in addition to the strength that we have in the US.
Thank you. And our next question comes from the line of Scott Wurtzel from Wolfe Research. Your question, please.
Hey guys, thanks for taking my question. Just wanted to ask on the growth that you're seeing with hedge funds. It's been pretty impressive, I think, in this quarter, and I think in the past couple of quarters as well. Just wondering if you can maybe contextualize like what inning we're in this opportunity to sell into the hedge fund channel, just given the growth that you've seen in recent quarters. Thanks.
Sure, and maybe I can broaden it to traders, broker dealers, hedge funds. What we've referred to as the trading ecosystem in the past. This is an area, as you alluded to, it's been a strong growth area for us. It's been our highest growth area for the last couple of years, but it's also very strategic for us. And so we've seen growth in both index, where we actually had 27% subscription run rate growth within index with hedge funds. On analytics, we saw 14% subscription run rate growth with hedge funds. We've similarly had very strong traction with trading firms and with broker dealers. And a lot of this is fueled by our actions. We have benefited probably by the health and asset growth that you've seen within multi-strat hedge funds, the growth of certain strategies. But importantly, we have been actively innovating, enhancing the services that we deliver to these organizations. And we have been becoming much more of a enterprise-wide partner to many of these organizations. And so we are offering things like, we see custom indexes used for structured products, over-the-counter derivatives, custom bespoke strategies. We have custom index sets, content sets that are used for systematic and index rebalancing strategies related to that index methodology data sets. We continue to enhance our risk models and broader systematic solutions, which create additional upsell opportunities. And so we believe this is a big market where we will be a critical partner to these organizations. And it's a sustainable area where we have a long way to go in terms of doing more for them at an enterprise level, being a strategic partner for them. And as I alluded to earlier, this is very strategic for us as a firm because it helps fuel opportunities in the ETF market, the non-ETF passive market, the over-the-counter market as well. And this is something that provides more liquidity and more opportunity for asset owners that are looking to implement index strategies, even opportunities within the wealth segment. And so this has been a nice growth engine for us in the short term here within those three specific client segments. But more generally, this is something that's helping to fuel the power of the overall franchise for us. And so we do believe it's attractive and sustainable. And we continue to innovate and enhance our service there.
Thank you. And our next question comes from the line of Kurt Nagel from Bank of America. Your question, please.
Great. Thanks very much. Just kind of going back to the net new, very obviously notable in 1Q. Great results. I guess, would you be able to, Andy, disaggregate, how much of that was due to, it sounded like some, larger concentrated deals, which, alluded to the prepared remarks versus, again, the substantial increase in product velocity and execution. Just any comments on that would be helpful. That's my question.
Sure. Yeah, we alluded to this earlier, but we did see, as Henry mentioned, we saw a notable pickup in number of new products launched in the first quarter, but we also saw a notable increase in sales from new products compared to the first quarter of last year. And so our actions are definitely playing a role in the impact we've seen, the acceleration in growth we've seen. If you look at where some of that momentum is, we've seen strong momentum in areas like index, where we're accelerated back to double-digit growth there. We've seen an acceleration in PCS. On both fronts, we have been very active in pace of new product development, as well as enhancing our go-to-market efforts. And so things like new index content sets that we've been delivering, things like within PCS, a whole host of new capabilities, like our document management and source view offerings, like our asset and deal level metrics that you've seen, a number of content sets that are helping drive growth across basically all of our PCS offerings are all things that have been released in recent periods here. And then obviously on the custom index side, as Henry alluded to, that's an area where we've been heavily investing, broadening our capabilities and become a partner of choice. And so, there's probably some environmental aspects at play. The sustained market momentum is constructive for us, but a lot of the momentum that we've seen has been driven by the efforts and actions that we've been taking.
That's long answers. Wow. Next question.
Your question, please.
Hey, thanks for squeezing me in. So I wanted to just talk a little bit about some of the momentum since the February rollout of the Index AI Insights.
Yes.
Sounds like that's driving increased monetization, or at least a little bit of a pickup in licensing data. And I guess I'm wondering just how the economics on that might differ.
Yes.
Whether it's going through MSCI or third-party apps like Claude or ChatGPT. Thank you.
Great question.
Yeah, sure. So consistent with our past approach, we want to make our content as easily accessible and available however clients want to get access to it. So as we alluded to, you can get access to it through Claude MCP, through MSCI One. We even have certain content sets available through Copilot. The economics are generally consistent regardless of how clients access it. There are some, depending on how and where they're using it, there can be upcharges and upsales for us. But our goal is to make it easier for clients to access the content and use it in a multitude of use cases. This is something that is one of those areas where we are increasing value to clients. So as we alluded to, we've seen a notable pickup or notable traction, given that we just released it in February, but notable traction in clients who are accessing the Index AI Insights. We see clients who are getting more value out of the content sets they have so they can query, interrogate what's going on in the index, what drives the methodology, what are the constituents. It's also a natural upsale driver for them to ask for additional content sets to want to get insight to our risk models across the firm. And so we think this is a key enabler. It does help support price increases on the margin. It's something that can lead to upcharges around, as I said, usage. But this is step one for us. And over time, we think clients are going to want to use more of our content within their AI-driven processes. And so as they start to want to use that content to train models, use this for their AI investment processes, those are areas where there are meaningful sale opportunities for us. And we are spending a lot of time thinking about the right licensing models there, how we can capitalize, because we know directly from our clients that they want to use our content heavily. And these initial ways that clients can access the content via the AI channels are the first step. But we continue to believe there's a long journey of additional things that we can do and opportunities to monetize the content we have.
Did you highlight it? This sentence. It does all the AI stuff, the implementation. It does help support price increases on the margin, pricing power. They will have the ability to give so much value to their customers that they will be able to raise their prices. Incremental margins, beautiful. So yeah, they are using AI a little bit everywhere. I mean, if you are a fund manager, you have a portfolio of stocks, you say, can you ask a prompt to Claude or ChatGPT saying, now what if oil prices go to $150? What will be the impact on my portfolio? And which ones of my companies will be impacted the most? And boom, in one prompt you have one answer. This is the kind of query people will have. This is the kind of questions people will have if they use their Index AI Insights. Okay. Can you create a custom index for ESG companies, half stocks, half crypto, with low volatility and no exposure to China? Boom, you have your custom index. I mean, it can be quite fast. Next question.
Thank you. Your question, please.
Hey, good afternoon. Thanks for taking my question. There's been a lot of fear in the private credit markets recently around, I guess, credit risk. So curious if you could talk about how that's impacting your PCS business. Is it a headwind? Is it a tailwind? How's it impacting you? Thank you.
It's definitely a tailwind for us. So think about it similarly to our analytics offering, equity factor analytics and multi-asset class analytics. The period of highest interest and highest demand is when there's a lot of volatility in the marketplace. So then what we're seeing right now in private credit is because of the lack of transparency on the funds, people don't understand what the sort of sector exposure of various credits are, what the valuations are, what the liquidity is, and all of that. So there is increasing interest in a lot of the tools that we provide. The transparency tool, understanding, what is it that is in the fund, what are the terms and conditions of the loans in the fund, what are the credit assessments, in this partnership we have with Moody's on those funds, what is the market risk of those funds based on factors, and the like. So I think that we're increasingly focused on creating valuation, private credit. So I think this is a major tailwind for us. There will be more and more people wanting to look at that in order to understand what they bought and whether they should keep it or sell it or add to it.
Good answer. Next question.
Question, please.
Good morning. Thanks for taking my question. How does AI change the competitive dynamics for you, particularly for the analytics business?
Wow, so many questions about AI. I know it's the big topic, but all of the questions are about AI. Oh, this is good. This is bullish. The management is bullish about AI. It seems like they want to share a lot of information about AI. They will explain their AI strategy. So it's the opportunity for the management team to shine. I guess that's pretty bullish.
Are you seeing any intensified competition there? And if so, is it coming from other startups or large customers who may try to build some of these products themselves? Thanks a lot.
Good question.
It's a very good question. So far, we haven't seen any kind of competition or intense competition from either the traditional competitors of MSCI or the upstarts, the startups. We're not relaxed. We're monitoring and focused on that intensely just to make sure that we continue to have a very deep and wide competitive moat. What we have seen is a significant acceleration, from MSCI in terms of product creation, starting with gathering more data, to accelerating the pace of model creation and methodologies and index, to do all of that, and obviously the efficiencies that we can create are things that can help us save headcount and help us save expenses that we can then reinvest into even more product creation and more distribution.
Again, they all mentioned that they are not in the hiring process.
So that's all in progress. I believe personally that the ultimate big sort of opportunity for us is not only in the data and the models and the enhancement of the software capabilities that we have, but it is in changing the business model of how our clients consume our content. As you know, a lot of our content is consumed either by our own applications, BarraOne, Risk Manager, Private Eye, etc., or the clients have their own software applications, or by third-party applications that aggregate our content with others. Through what we're doing, which is that significant increase in the creation of agents that our clients can use to consume our content, we can change that. We can get clients to consume a lot more of our content with a lot more people in many different locations, and that's what we're aiming for in the medium to longer term, and that will redefine dramatically how clients consume our content, and it will give us a lot more control and give us a lot more ability to expand.
Thank you. This does conclude the question and answer session of today's program. I'd like to hand the program back to Henry Fernandez for any further remarks.
Always good to listen to the last remarks from the CEO, especially for this company. Every time the tone is changing, the words are changing, the sentences are not the same. So let's see what he says.
Well, thank you all for joining us today. I would like to emphasize that our strategy here, last year and going forward, is a strategy of significantly increase the pace of growth of our existing product segments like index analytics with our traditional client segments of asset owners, asset managers, hedge funds, broker-dealers, etc. And simultaneously step up significantly the pace of development and growth of our newer product lines such as climate and PCS, and sold to the traditional client base and newer client bases like GPs and and banks as principals and insurance companies and other parts of market makers and other parts of that trading ecosystem. So that ultimately we become an even bigger long-term compounder of growth, which has always been our goal. So we're on the way on that strategy. The benefit of what you're seeing, what we're doing right now, is that this is not like growth in the periphery. This is growth in the existing big part of the product line with the existing clients and the like, and then it's going to be highly supplemented by the newer product lines and the newer client segments, to add to that growth. So we're very optimistic about that, and it's an all-weather franchise. We're diversified in many aspects of what we do across products, across client segments, across asset classes, etc. So it's a great franchise, and the question is, how far can we and how aggressively we can optimize it and monetize it to develop compound growth over the years and significant value creation for all of our shareholders, including our shareholders in the management team. Thank you very much.
Thank you, ladies and gentlemen, for your participation in today's conference.
Perfect. This is the end. So what did we learn in this earnings call? The focus is in AI. They don't want to hire anymore. The business is fine. Sometimes for answers, they were too long, too many words. So I hope you did not sleep. Yeah. What else? They are still seeing strong opportunities, more inflows coming in Europe. This is the main driver, emerging markets, developed markets, ex-US, and they are putting AI everywhere. And very recently, in February, they implemented a new AI index stuff to create your own custom index. They are also partnering up with ChatGPT and Claude to implement AI everywhere, and they are not seeing any competitors emerging. They say they are not relaxed, so they are monitoring everything, and they are partnering up with big LLMs, and they will continue to add more database. The moat of MSCI is the proprietary data. So they have the exclusive private data, and they will be able to use this data, given you have more acquisitions now, to gather more data. So it seems like the growth is here, and the growth will continue, and because the costs will not follow, margins will increase. We are not hiring anymore. We will continue to grow revenue at a very good pace and improve our margins very sustainably. I would not be surprised if the stock continues to go up from there. I like this report a lot. The call was pretty decent, pretty good. Maybe this is our opportunity as shareholders to see all-time highs again. Maybe this is our opportunity. Now I want to leave you with two things. I want to talk about the valuation. Is this updated? What is the forward price to free cash flow of this business? Forward price to free cash flow right now is 27. A couple of weeks ago, it was at 25 when the stock dropped, right? I bought the dip, by the way. Now it's at 27. It can be higher. If you look at history, this ratio fluctuated a lot. In 2018, you had 25, it was a low, and it rebounded to 30, a forward price to free cash flow of 30. Then it went up immensely to 50, 55, it was expensive. I was not a shareholder at the time, and it dropped. And at the middle of 2025, I started buying when we dropped below 30. And I bought more and more and more, and bought the dip, and bought the dip, and bought every dip, okay? Now we are at 27. For a very strong business with growing margins, growing revenue double digits, okay? So valuation-wise, if you look at the multiples, we are not cheap, right? Not cheap, but we are not expensive. It's fair value, I would say, right now. You have the opportunity to buy a wonderful business at fair value. Life is good. Now I want to talk about Stock Unlock, and we'll do a DCF and a valuation model to find an intrinsic value of the business, and that will be it for today. I can use this wonderful website, Stock Unlock. It is the best website for a DCF. You have two things to monitor on Stock Unlock to check the valuation. I'm using this on a daily basis. You have a discount code in my description if you want to use. This is the best DCF model by far. You can check a new tab they have called Scores. It's great, especially for this chart. You have this chart over time. It takes into account the valuation. When it's green, it means it's cheap, so you can buy. And when it's red, it means expensive, don't touch or sell. you see that when you had the forward price to free cash flow of 55, it was red. Don't touch, too expensive. And then it dropped to green in 2024, rebounded to red, and then starting in 2025, when I started to buy, it became green. And then in February 2026, green again. I bought the dip again. And then again in March, green. I bought the dip again. And now we are at a grade of 3.75. And despite the rebound, we are still in green at 3.5. Why? Because the fundamentals are updated and have improved over time. So according to this model, MSCI is still a buy. Is still a cheap territory according to their model. The second thing I want to check is the DCF. If you check the DCF, you can kind of forecast what will be the growth rate for the future. As we've seen before, this is a business that can grow revenue at double digits. 11%, 12%. I mean, now they are doing 14%. So maybe they can grow revenue at 12% per year for the next 5 years. Okay? You will have margin improvement. So let's forecast the free cash flow for the past 5 years. You start from a revenue growth rate of 12%. Then a little bit of margins. So net income grows 14%. Free cash flow can grow at 14%. Let's be conservative, not be extremely bullish. Let's say the free cash flow grows at 14% for the next 5 years. Let's say the business comes back to normal, valuation-wise, and you have a price to free cash flow of 30. I mean, now we talked about the forward price to free cash flow, but what is the trailing, the normal price to free cash flow? It is the same, 28. Same. Okay, so we are definitely in this range of roughly 30. Okay, let's say the valuation expands a little bit, but back to the average after all. I mean, you can look at the median and the average, it will be the same. This is what we have. So let's put 30 here. The discount rate, you put 10%, as always. How fast will dividend grow? I put 0% for the sake of being conservative. And how much buybacks do you do? Let's say a buyback program of 2%. Now they're doing 6%, but in the future, I don't think they can do 6% buybacks every year. So let's say buybacks will be less in the future, less buybacks over time. So if you think free cash flow can grow at 14% per year for the next 5 years, they deserve a price to free cash flow of 30, and they will do 2% buybacks, then the stock is 30% undervalued today, even after the price increase from the report. 33% undervalued. The fair value is almost $800. And if you buy right now, the CAGR, the compound annual growth rate, is 16.5%. Am I checking the right numbers here? Yes. So if you buy right now, you can expect to make a performance, to have a gain of 16% per year. This is why I am bullish MSCI. I think it's a very sustainable business with a reasonable valuation, right? We are not expensive, but not crazy cheap. And it can grow double digits for a very long time with a wide moat. Now you can be more pessimistic. What if the free cash flow grows 12% per year and they deserve a price to free cash flow of 25? Okay. If this is the case, if you are more bearish, MSCI is fair value, like 3% undervalued, almost nothing. So let's say fair value. The fair value is this, $615. And the CAGR, the performance you can expect going forward, is 10% per year. It's not great, but maybe you can beat the market with this kind of performance. And that's being conservative. What if you are being optimistic and bullish? Instead of growing 14%, what if we grow back to 16% like we had a few years ago? The free cash flow can grow at 16% per year for the next 5 years. And let's assume a price to free cash flow of 30. If this is the case, then the stock is 45% undervalued. The fair value is almost $900, and the CAGR, the compound annual growth rate, is 18% per year. So in a bullish scenario, this can happen. You can make 18, 19% per year. given what they say about cost, efficiency, improving margins, and revenue opportunities in the future, growth potential in the future, this scenario can happen. And the free cash flow can grow immensely in the future. They will do massive buybacks, and shareholders can make 18, 19% per year. Okay? I would not be surprised if this happens actually. Okay? So, check on my description if you want to use the best DCF model and make the estimates yourself. Check in the description how to create an account for Fiscal AI to use these charts, the KPIs, create your own custom index. Because I have shown you the work for MSCI, but you can do this exercise for all your companies that you are analyzing, creating custom metrics for all the companies you are analyzing. Cash flow statement, you have the investor relations, you can see the slides, the report, the transcript, everything in one mega super app. So I definitely recommend you check out my link in the description to use Fiscal AI. Try it out for 2 weeks completely for free, and then it will get cheaper if you go through my link. And I think all in all, MSCI reported a very good earnings report. I'm a very proud shareholder here. It's 13% of my portfolio, and I plan to hold. I will not buy. If it drops back to 500, maybe I will buy more. Now, as the stock is going up, I just want to hold and let it run. The business is operating in full force, growing nicely. And what if markets go up globally right now? The AUM is at all-time highs. The inflows of capital all-time highs. What if markets go up? The growth can go even higher at the moment. I will not speculate whether markets can go up or down in 2026. Nobody knows if markets will go up or down. It will be too easy. But if markets go up meaningfully this year, MSCI will print cash. They will upgrade their guidance, upgrade their margins. It will be wonderful. So I'm very bullish for the long term of MSCI. I hope this long video was helpful to you. Don't hesitate to leave a like, comment, and subscribe. That always helps for the algorithm. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.